certainly by the fall, I think we will start to see the impact of slower growth.
Stagflation is an increasingly bigger concern.
Chances are, with what we know, lower inventories, fewer selections, and higher prices.
Dislocation between the soft data weakening and the hard data kind of muddling along.
There's a big gap between confidence, sentiment, and the results.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Heading into the weekend, wrapping up a week of deal making.
The China deal is a very big deal. They wanted to make that deal very badly. And we have, at the same time, 150 countries that want to make a deal. At a certain point over the next 2 to 3 weeks, they'll be telling people what they'll be paying to do business in the United States. I think we're going to be very fair, but it's not possible to meet the number of people that want to see us.
Soothing words from President Trump happy to send equities towards a week of gains. The president returning to Washington as House Republicans close in on a tax deal, leaving the Fed firmly on the sidelines as President Bostjancic sees only one rate cut this year, despite softer than expected reads on inflation.
So are we looking at the right kind of downside surprise where once again, bad news is good news as long as it's not too bad? And what we can see is people pricing the Fed back in the game, even though they're saying, look, we're not in the game. We're actually waiting and seeing. But other people want to see them cutting rates. What I was struck by is that we've got PPI yesterday, a data point that previously has been dismissed, that initially didn't have much of a reaction in markets. And as the day went on, people coalesced around a narrative that it was the right kind of disinflationary shock that would overwhelm any kind of implications from the tariffs.
And just like that, bond yields down 10 basis points. I'm looking at two other data points. One data point, Walmart. The other data point, the Port of LA director on this program. Walmart saying we can just about hold on before we pass on higher costs to the consumer. The Port of LA director coming on the program and saying even though tariffs are down to 30%, he doesn't think it changes the situation on the ground that radically. That's a situation to watch.
And Bloomberg Economics agrees, thinks that actually it materially shifts the economics in the U.S. exporting goods from China. So you start to frame out, okay, there are people saying, actually, we're seeing tariff rates at many multiples of what they were at the start of the year, and that's going to have ramifications for pricing. And then you have other people saying, well, the softness elsewhere, in particular with airline fares, in particular with gasoline prices, in particular with eggs, will offset anything else that might come down the pike.
Do you know what I thought when I woke up this morning?
What did you think?
This is nice, it's quiet. It's like the quietest morning we've had all week.
You know, you are going to eat those words. I hope that you don't.
I
will just say it is Friday. You're not allowed to say that until 8:56. But
our next guest is alongside us saying steady on, steady on. I hope it remains quiet. I'm sure you all do too. Equity futures right now in the S&P up by 0.2%. Coming up shortly, we'll catch up with Goncalves of MUFG with stocks on a 4-day winning streak, looking to make it day 5. Edward Fishman of Columbia University as Ukraine ceasefire prospects dim, and Andrew Hollenhorst of Citi pushing back his Fed rate cut forecast. We begin this hour with our top story. President Donald Trump wrapping up his tour of the Middle East. Joining us now from Abu Dhabi is Annmarie. AMH, let's get to it. What a week. What a week for the President of the United States.
Absolutely. Tons of deals the president was able to secure between Riyadh, Doha, and yesterday here in Abu Dhabi. And amongst all the fanfare, Jonathan, between horses and sword dancing, even they've done everything to roll out the red carpet and make the president feel at home. You had Mohammed bin Salman, the crown prince, at one point driving the president in a golf cart. So he definitely felt at home here in the Gulf on this tour. When it comes to the deals, the highlight had to really be AI. Yesterday, I was struck by this image as Commerce Secretary Howard Lutnick signed on to this document for an advanced AI partnership between Washington and Abu Dhabi. They're planning to build the biggest AI data center outside the United States right here in Abu Dhabi. Standing between President Trump and Sheikh Mohammed bin Zayed was no other than NVIDIA's Jensen Huang. You can see that this is now going to be a place where those advanced high-tech chips can get into the region. For an individual that runs NVIDIA, this was a huge win for the week, something very different in terms of the path that was going down when it comes to the Biden administration. But for these capitals like Riyadh and Abu Dhabi, they need to make sure that that technology does not get into the hands of Beijing, to make sure, Jonathan and Lisa, they are staying on side of what Washington would like to see coming out of the region.
Annmarie, I'm sure that you have enjoyed the hair-flipping dance, the sword dancing, as well as the camels that have been paraded in. It has been quite a spectacle. I am curious what the reception will be back at home when President Trump arrives in Washington, D.C., about this idea that the Middle East is the new power broker, and that in some ways the gravity of power making is shifting away from Europe toward Riyadh, toward Abu Dhabi.
Well, the president departs pretty soon. He's going to be welcomed with a ton of headaches in Washington, D.C., as, really the balance is hanging on whether or not his one big, beautiful bill can get passed. One of the biggest sticking points right now, and I know you guys will be speaking to Congressman Lawler of Westchester, someone that's in the thick of this fight, is where the SALT deduction cap is going to go. Can it rise above $30,000? This is something that is really critical to Republicans from high tax states like New York. But the problem this president has is that he has a majority, but they're very slim, and there's a bunch of different competing factions right now. It's going to be a working weekend for the House of Representatives, for Speaker Johnson. I'm sure the president will be putting on his speaker hat, making those phone calls. We should note there's one piece of good news for the president as he touches down in America later today. He told reporters he has a new grandson, so I think he's looking forward to meeting his new grandson, and then probably a bunch of headaches dealing with Congress.
Congratulations to the family. Annmarie, thank you. AMH, over in the Middle East, the president coming back to a bit of a fight over this tax bill.
It was supposed to be done. It was supposed to be wrapping up so they could get it through by Memorial Day and then passed by Independence Day. And right now, they are embroiled in a battle over everything and anything because a big, beautiful bill comes with a big, beautiful headache that a lot of them are grappling with.
Tyler Kendall joining us from Washington in about 10 minutes' time for an update on that. Look out for that conversation. Here's the view from Wall Street this morning. George Goncalves of MUFG writing the following: we still believe that the damage has been done after the tariff shock. We do not think that a risk rebound has changed the medium-term macro outlook. George joins us for more. George, good morning.
Good morning.
You've said repeatedly, and I keep seeing it in your research, this line here, the longer they need to wait, the more they need to do. What convinces you of that?
Look, I think we're in a different place than we were in 2022, 23, when all these sentiment surveys were a head fake. And this time, obviously we're further along in the business cycle, and we have much more tighter financial conditions, at least from the Fed side of view, from the market side of view. We would be having a different conversation if stocks had not rebounded, right? We would have been still in the doldrums, oh, this is painful, equities are lower, spreads are wider. They've all snapped back, and I think that is giving kind of a false sense of confidence that we've kind of passed the worst of it. I think we haven't seen it in the numbers, and that soft data does eventually translate into harder data, because I don't see how corporates and consumers are going to just flip their behaviors.
Matt Lazzetti, Deutsche Bank. Financial conditions have unwound the tariff shock. We're near the easiest level since early 2022, prior to when the Fed began aggressively tightening. How much does that smooth the landing?
I don't think enough, because it's fickle and the markets come and go. We can have 6 weeks ago we were down 15, 20%, and now we're back to flat. Let's see how it goes in the next couple of weeks. We don't want to hang our hat on just the financial conditions tightening aspect, but the Fed is passively tightening. The longer they wait, with inflation coming down, they're hanging their hat on inflation expectations, and they know very well that inflation expectations are really driven by near-term inflation. So if inflation keeps trending, they really have no excuse but to ease. But we also changed our view. We moved it back from June to July. But we're consolidating. I think the longer the Fed waits, the more they're going to have to do.
I remember as long ago as yesterday, people were talking about tariffs possibly being inflationary and that PPI didn't matter because it's never really mattered, and that basically it's a fickle measure, that actually the revisions were upward when you look at core PPI for the previous month. Real question mark also about what it means going forward. Yeah. Are we now on this idea that disinflation has taken hold and will offset any kind of pressure from tariffs?
I wouldn't go as far as disinflation, but I think it just kind of strengthens that kind of argument that we're going to have mixed data throughout this period. We're not going to really know where we stand. But it does argue that a lot of it was pulled forward in Q1, and that kind of pricing pressures. Now the question is, did people actually get the inventory they want? Is there going to be fire sale of inventories that people don't need in the second half of the year? I think it just creates a lot of noise.
So not to be overly existential about this, but everyone comes on and tells us that they can't rely on the data, that it's backward looking. Don't trade on it. We're not going to trade on it. And then everybody trades on it and basically creates some sort of narrative that then permeates the markets for a full day or maybe two. Who is trading right now?
I would say it's active traders. I think that a lot of the investors that we speak to are hugging their benchmarks, especially in the fixed income space. You're actually paid to kind of wait because yields are high enough. And now, like spreads have tightened, so credit's a whole other story. But in high quality, short duration assets, you're paid to wait.
Are they prepared to ignore bad data?
I don't think so. And that's where it really presents an interesting proposition. The bond market, especially the rates market, has had a big sell-off, enough of a sell-off. And now we've kind of retraced the last day and a half. But we've been exploring the upper limits of higher rates. We'll look back one day and say, hey, those might have been like the near-term highs. And I think that investors should be averaging in. Like typically what we see is people say, oh, treasuries are a hedge to their portfolio. But instead, they chase the treasury market and they end up buying 2-year notes when they're at 3.5% instead of buying them north of 4%.
They become momentum traders.
Part of it, for sure.
In a moment, we'll talk about the tax bill. And we'll get your thoughts on a more deeper level in a moment on that. But I want to understand from your perspective, when you say things like people might regret not buying at these levels, I'm paraphrasing here, even in the face of the tax bill that's coming in Washington, D.C.?
Well, so that's going to be interesting, right? So I think that's what I think we mentioned it last time as well when I was on the show. We've really bifurcated the bond market into many different pieces. We have short-term treasuries and long-term treasuries. The long-term treasuries are a different story. I think that's where the sort of fiscal impasse, if it gets drawn out, I think that's where most of the term premium will reside. But even then, at some point, there's going to be value in the 30-year.
You're going to stick with us, George. We'll get his thoughts on the tax bill in just a moment. George Goncalves there of MUFG. That has been the big focal point, I think, for fixed income this week. Never mind the data. It's that tug-of-war between the disinflationary data, CPI, PPI, and a prospect of a major tax bill coming together in Washington.
That puts fiscal deficits of something like 6.4% on the table. So 333 is not exactly what we're looking at right now. And people are getting really nervous. And when do the bond vigilantes start to rear their heads and say, no mas?
Not right now. 486 on 30s, 10s, back down to 440. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. Republican infighting in the House is threatening President Trump's one big, beautiful bill, as you were just speaking about. The biggest issue, the SALT cap. A group of lawmakers from high-tax states, including New York and New Jersey, vowed to vote no on the package unless the cap is raised or abolished. Lawmakers have said they'll continue to negotiate throughout the weekend. Meanwhile, Meta is delaying the rollout of its flagship AI model called Behemoth. That's according to the Wall Street Journal, which reported Meta engineers are having trouble improving the capabilities of the large language model. The report says Behemoth's release has now been postponed to late 2025. And New Jersey Transit train engineers went on strike at 12:01 a.m. this morning, leaving tens of thousands of people looking for other ways to get to work this morning. The walkout comes after the latest round of negotiations failed to produce an agreement. It is New Jersey's first transit strike in more than 40 years. That's your Bloomberg brief. John?
Yahara, thank you. So road traffic's going to be fun today, right?
Oh, I think a lot of people are going to just stay home. I'm just going to suggest
Obviously, it's going to be quieter.
It's going to be a work from home day.
Okay, I'll take that.
If
stay in New Jersey.
Stay there. No, but I mean, come on, wouldn't you? I mean, if you were going to face off with terrible traffic, I can't get in.
I would do the same thing. I'm happy to make that argument for them right now.
I mean, for me to drive in and it's going to be stuck in traffic for 2 hours. So enjoy your time. Have a great snack.
I'm with you.
Kids.
Don't flood Midtown. It's basically what Bramo's trying to tell you. Up next on the program, the SALT bottleneck.
The tripling of the deduction to $30,000 covers 98% of my district. Now, would I have liked a higher number? Sure. But it's not what you want, it's what you need.
We'll get into that compromise. Coming together down in Washington, D.C. with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Four-day winning streak on the S&P 500. This could be day 5. Equities up by 0.2%. This from Chris Harvey of Wells Fargo this morning. An opportune time to revisit the AI picks and shovels trade. An easing of trade tensions coupled with liberalized chip export rules have sent the S&P 500 Infotech up 8% this week. He believes the rally has legs. It has legs this morning. The Nasdaq 100 up by 0.2%. Under surveillance this morning, the SALT bottleneck.
Salt right now is roughly, it's about 215 billion. We want to stay within that piece. Now, that may mean we need to adjust the dials. The tripling of the deduction to $30,000 covers 98% of my district. Now, would I have liked a higher number? Sure. But it's not what you want, it's what you need.
Here's the latest this morning. Republican infighting over salt remaining a key hold-up in the passage of the president's tax bill. Joining us now from Washington is Tyler Kendall. Tyler, does Congresswoman Malliotakis have some company in the salt caucus?
Yeah, hey, John, good morning. At this point, she really doesn't. While she says that her constituents would be fine with lifting that salt cap from $10,000 to $30,000, the rest of these lawmakers from these high-tax states like New York, New Jersey, and California say that number needs to get bumped even higher. The thing is, it appears they can't agree on what that level would be, as well as how that would be accompanied by income limits, phase-outs, or an expiration date. So there's still a lot that really does need to happen here, and it's becoming a tug-of-war between these moderates that you see on your screen there, but then also those fiscal hawks who say that any increase to the salt cap ends up being too much. And at the moment, they're holding some pretty big cards in their hands. They're threatening to tank a budget committee vote set for today over these concerns about what lifting the salt cap could mean for a loss in revenue. And for context, this vote today, it was supposed to be routine. This is basically what lawmakers have to do to bundle up all the different parts of this bill, put it into one piece of legislation, and then get it out the door. But as of now, that might not happen, as members of the House Freedom Caucus say that they need to see some bigger cost savings. Now, to be fair, their concerns, of course, John, aren't all about salt. They're also demanding some changes when it comes to the planned work requirements on Medicaid. They are trying to pressure House leadership to move up the work requirements from being phased in by 2029 to as soon as next year in some cases. But really, John, it all just highlights one of the biggest issues with doing this as one big, beautiful bill, because Republicans get to fast track this through reconciliation. They're not negotiating with Democrats, but they do have to negotiate with themselves.
Tyler, how much is this becoming a proxy debate for the heart and soul of the Republican Party? And I say this, and it sounds quite dramatic, but the moderates are painting themselves as the reason why there is a majority for Republicans in Congress. And the conservatives are saying we are the party of Trump, and we have to keep our budget in order. How much is that the reason why this is getting increasingly messy?
Right. There is definitely a push and pull here between the factions of the Republican Party as they really try to coalesce around an issue ahead of the midterms. And I know it seems like we're far away, but here in Washington, we really do start the countdown to the next election as soon as the last one ends. And reconciliation is really going to be a centerpiece for it. And it's clear that Republicans want to get cash into consumers' pockets as quickly as possible. But they're also, of course, dealing with a few different threads here when it comes to that some of these tax cuts are going to expire before President Trump, or right as President Trump leads office, and then contending also with what that could mean to their political messaging around planned cuts to Medicaid and also the Supplemental Nutrition Assistance Program. So at the end of the day, though, the uniting factor really could be President Trump. But of course, he has said before that he does have perhaps a warm spot when it comes to lifting that salt cap as a fellow New Yorker himself. At the end of the day, Lisa, we're waiting to see when he's going to start making those calls, because really the White House needs to get this part of their agenda done.
Tyler, thank you. The latest down in Washington, D.C. with Tyler Kendall, still with us here in New York. George Goncalves of MUFG. George, we go back to the post-election question. Will this bond market constrain the ambitions of Republicans in Washington?
So I do think that this sort of impasse infighting is kind of capturing the essence of this fiscal concern that the bond market has. And obviously there's factions within the Republican Party that are arguing their side. But we started off the year, let's remember, with two things. One, tariffs were going to lower the dollar. Strengthen the dollar. And that Bessent's plans and these kind of arguments that we're going to be more fiscal consolidation, that rates were going to head lower. And that kind of two-prong approach would actually be beneficial for the economy. We got the opposite, right? And then in addition to that, in the heat of the moment during the post-Liberation Day, when we're seeing all that volatility in markets, we were also starting to get word that the Doge cuts aren't real. They're not going to really come through. And so the bond market was picking up on two things. That A, we're going to go back to being fiscally irresponsible. And so this really does, I think it's been in the background while we're dealing with the tariff sort of shock and now this rebound. I think the bond market is clearly going to be the arbiter.
You mentioned the currency. Let's sit on that just for a moment. Fiscal stimulus leads to a stronger currency. Fiscal irresponsibility leads to a weaker one. What does this tax package mean? Is it stimulus Or is it irresponsible? And what does it mean for foreign exchange?
Look, that's a great question, great point. I think that what happened in the last month or so with foreign investors really rethinking their holdings of treasuries, de-risking, going down the curve, looking for dollar hedges for the very first time in quite some time. I mean, that started to be borne out in the data. And I think argues for a defensive posture from our overseas investors, that they look up and say each time the U.S. gets into this sort of situation, needs more stimulus, and they just print more money, more treasuries.
So why aren't we seeing it more? I mean, we did see it from hot second and 30-year yields, but why aren't we seeing it more in a sustained kind of weakening of the dollar, given the fact that everyone comes on the show and says a lot of investors are getting really hesitant on buying U.S. assets, but they're still sitting on their hands. They're still kind of checking it out, and they still kind of like U.S. assets. Well, I mean, U.S. assets is a broad category of many things. When it comes to the building blocks and the foundation of the banking system and liquidity, treasuries are tantamount. And so I do think it's definitely shown up in there. I mean, the Fed has cut rates. There's still rate cuts in there, although they've come out, but still long-term rates have risen. So I think that it is being captured through term premium. If it wasn't, the curve is steeper. So I think it is being captured. And there's people go to even a further, more lengthy kind of theoretical that even credit maybe is looking better than treasuries. That we're now at this point where we're comparing sovereigns to actual individual companies. Like when you get that far, maybe we've gone too far. But I think the conversation is being made. So why did you say in the prior segment that you think that this is a real entry point for long-term bonds if there is this existential concern that could potentially push term premia well above what we've seen in recent history? Because, look, no one knows exact timing, right? And the point is everything will come to pass. And the argument that I'm making is more about dollar cost averaging. I don't know exactly when the right time is, but what I do know, what I feel pretty confident not know, is that we cannot afford rates above 5%. It will start to impact the economy and other parts. And then you get that negative feedback loop into other asset classes and a shift from other assets back to treasuries. And so it's kind of that kind of song and dance that the higher rates stay, the more likely something else will happen.
A lot of people have moved on from April 2nd. Big time. You've seen that in financial markets. You haven't. You say things like the damage is done. You're going to see it in the economic data. You also think about international investors and the attitudes to US assets. Just build on that a little bit more. Do you think there is some scarring there? That this isn't quite as repairable as some people think it is?
I think, look, there's obviously always a place for treasuries, but I do think that there has been some damage done, and now there's actual viable alternatives. This is the irony. The Fed is dragging their feet to cut rates, in my opinion. The Fed cuts rates, it would actually get investors to buy treasuries because they're going to rally, and we're going to get that. You're going to get better funding costs for overseas investors that do FX hedges. They'll buy treasuries. The longer they wait, the longer they kind of push these foreign investors to stay in their local markets because European rates are attractive. Japanese rates are, yen rates are the highest I've seen in my career. We're talking about why would you come to the U.S.? You're going to stay home. So this is a completely different global bond market that we've been experiencing for the last 20 years. So I do think it has left some scarring.
There was a phrase we used earlier this week, Lisa. It was the great repatriation. That maybe some of these domestic investors would just invest money closer to home and bring it back.
Which is the reason why Jim Zelter said that the tail risk right now in markets is that potential for a Liz Truss moment, and that would actually inject some discipline on the fiscal perspective. Right now, it is unclear because this bill still is in sausage-making territory. At the same time, it does seem like the political momentum just is not there to make serious substantive cuts.
George, it's good to see you, as always, sir. George Goncalves there of MUFG. Lots to look forward to, including a fight between Republicans over the tax bill. And this tax bill could be absolutely massive. We said repeatedly through this week, just like that, Monday morning, trade truce between the US and China, bang. Market seems to move on to the tax bill.
Yeah, although moving on to the tax bill is also something of a headache because it's very difficult to understand exactly what's going to be in the tax bill. And one thing that we haven't really analyzed enough is what the ramifications are going to be for states, local governments, which actually have been accountable for the greatest proportion of all the hiring. So there are some pretty vast economic consequences from this that really haven't been gamed out in a market moving kind of way in real time.
And to George's point, don't move on too quickly.
Yeah.
Might see some damage from those tariffs in the economic data in the weeks and months to come. Certainly haven't seen it in a big way just yet. Equity futures on the S&P up by 0.25%. Up next, Edward Fishman of Columbia University as Ukraine ceasefire prospects continue to dim. 4-day winning streak on the S&P 500, higher every single trading day this week. Equity futures up again this morning by 0.25% as we head towards a really solid week of gains. The S&P 500 higher by 4.5%. With 3 hours until the cash open, let's get you some morning movers this morning. We can get those with Danny Berger. Hey, Danny.
Hey, John. We got a few things moving after the 13F filings yesterday. These are always backward looking from the hedge funds, but a lot of attention placed on Michael Burry's Scion Asset Management and what they did, because they basically got rid of all of their equity holdings, took out puts on NVIDIA, except for one stock. And that one stock is the one you're looking at, Estee Lauder. Those shares are up 5.2% because not only did they hold on to Estee Lauder, they also doubled the position. So investors taking a note from Michael Burry's book. Elsewhere, Applied Materials, the largest U.S. maker of chip-making equipment, reporting earnings yesterday, a very lackluster forecast for the current quarter. Really just underscores the adjustments the companies have had to try to make in order to comply with the chip restrictions coming from China. The CEO there talking about uncertainty, not talking about any extra demand coming from the Middle East. So those shares dropping 5.7%. Finally, rounding things off this morning with Take-Two Interactive, a video game maker that I swear really just trades on whether or not they're going to release GTA 6 Grand Theft Auto. Everybody's been waiting for this, but they've delayed it yet again until May 26th of next year. So they gave a forecast that has a loss for this year because it doesn't capture GTA 6. That disappointed investors. Those shares down 3%, John.
Disappointed gamers as well. Danny, thank you. Appreciate the update, including me.
Yeah.
Huge gamer.
Yeah, Grand Theft
Massive.
Auto. I see you all
up all night playing games.
I know. It's really.
I don't go to bed at 7 and wake up at 2 something.
No, you
I'm
need
playing
to,
games all night.
You need to kick the Grand Theft Auto habit, John. We really need to have a discussion.
It's a bad habit. I need therapy. And I'll rate down this morning. President Trump wrapping up a week of deal-making in the Middle East, securing $600 billion in Saudi investments, $200 billion in deals with the UAE, and more than $243 billion from Qatar. What should we call this? Investment commitments or deals? What is this?
It feels like investment commitments. We don't really have a sense of what the contours are. And there's some pretty glaring questions around what this actually means in terms of how they will build out their chip sources, exactly what the protections will be around said chips. The bigger picture, though, is the Middle East as a new power broker. And really, the dynamic is shifting away from Europe. And that is coming amid some dissent in Congress. And there's some people who are saying, should we be doing this? Is this a reliable partner in the same way that Europe had been? And this is going to be the geopolitical fight for a long time that I think is really fascinating.
The diplomat Jensen Wang says yes. I think that NVIDIA and the chip makers are very happy with progress that's been made this week. The rally we've seen in some of these names has been phenomenal.
Absolutely. This could potentially offset the lack of business they get from China. This is exactly what they wanted because the belief is in the technology sector, the more people who have access to it, the more we can advance. And this is better for humanity. Now, there are some security concerns when you talk about strategic decoupling from China. What does this mean about strategically decoupling from entities that could potentially be maybe adversaries? Again, who's an ally? Who's an adversary? This ultimately goes to the crux of that question.
The president wheels up in the Middle East. He's going to return to this fight. Republican infighting over raising the SALT cap, threatening the president's tax bill. A 2-hour meeting in House Speaker Mike Johnson's office yesterday, failing to address concerns. Lawmakers planning to negotiate throughout the weekend.
This should have been easy. Maybe. I mean, that's what they said, but I didn't ever really see how it could have been easy, but they said it could have been easy. To me, it really highlights the increasing schism between the conservatives and the moderate Republicans and how everybody has their agenda and they're all going to try to pack it in and how difficult it's going to be to get something across the finish line that doesn't blow out the deficit in a way that causes the bond market to say, hold on a second. And we saw a glimpse of that yesterday. So this, to me, could be the big market-moving event for the next couple of weeks as we figure out what the sausage looks like, how it gets remade, how it gets chopped up, how it gets cooked, and then how it gets delivered.
And what it means for fixed income and how fixed income investors will respond to that. And what the Federal Reserve is going to do as well. Atlanta Fed President Raphael Bostic's seen just one rate cut this year. He's told the Bloomberg podcast Odd Lots with Tracy Alloway and Joe Weisenthal that uncertainty is unlikely to resolve quickly, adding that he expects the U.S. economy to slow but not fall into a recession.
What was really interesting about some of his comments was that he talked about how the truce does change materially the economic outlook on some level. Again, I just wonder how they are even following a framework when the data isn't capturing real-time changes in policy and is backward-looking in terms of the economic ramifications. And that's the reason why a lot of what they're going to talk about is, could be. We aren't sure, but, inflation, check it out. And I do think that comments from Fed Chair Jay Powell, which I'm sure we'll get into later this show, really did underscore how much they're emphasizing inflation.
If in doubt, they've all got the same notes. Wait and see. We're going to wait and see. And that's what they've been saying over the last several weeks. Let's turn to geopolitics. Hopes for a Ukraine ceasefire fading as both the US and Russia send low-level delegations to talks in Turkey. This as leaders gather for the European Political Community Summit over in Albania. Bloomberg's Ollie Crook joins us now for more. Ollie, welcome to the programme. You've been speaking to European leaders. We just heard from the President of the United States on Air Force One saying that Putin and I may meet. We have to meet. What are European leaders saying?
Yeah, I think there's a lot of skepticism about Putin's commitment to any sort of deal and any sort of talks between Ukraine and Russia. And I just spoke to actually the deputy head of Zelensky's office, who actually just came from Turkey, arrived here in Albania. I spoke to him a few hours ago. And his point was that basically if you want to make any progress here, it's got to be Zelensky, Trump and Putin having those discussions, really getting around a table and starting to hash those out. Because these sort of low-level meetings, the interpretation from many European leaders is this is just part of the more slow walking the discussions around any kind of ceasefire, any kind of peace talks, and that Putin basically is not serious and that he's playing games. And that's quoting directly from a number of the leaders we've spoken to over the last few days. We should also say that another person that was in Turkey besides Marco Rubio was Lindsey Graham, who is the author of this new potential sanction list on Russia, these so-called bone-crushing sanctions that are designed to potentially clamp down on Russian oil and gas that would have a severe impact, really targeting them in ways that have not been seen before. The real question for European leaders and for Ukraine is, can they convince Donald Trump that Putin is the obstacle to peace? We have not arrived at that point, but we can tell in the way that Zelensky has been treating discussions and treating the Trump administration since that awful Oval Office meeting. Basically, whenever Trump says jump, he says how high and jumps twice as high. And that has been the technique to try to convince the U.S. administration that they're serious about peace and that Putin is the problem.
Certainly seen evidence of that this week. Ollie, appreciate the update, sir. Ollie Crook there on the ground in Albania. Joining us around a table here in New York, Edward Fishman, professor at Columbia University and the author of the book Choke Points, American Power in the Age of Economic Warfare. Eddie, it's good to see you, sir.
Good to see you too, John.
Do we know what both sides want? Do we know what Ukraine wants? Do we know what the Russians want?
I think there's still major divides between the Ukrainians and the Russians. And I think the issue right now is that Putin believes that time is on his side. The reason he's kicking the can down the road, the reason he's kind of saying, oh, well, I'll show up in Turkey. No, I won't show up in Turkey, is he thinks that if he can just push this out, get to a big Russian summer offensive, they can take even more territory, be in an even stronger position. It's worth recalling that at the very beginning of this special military operation, Putin said that his goals were to demilitarize and denazify Ukraine. What that means is they want Ukraine to have no military and they want Zelensky to get out of Kiev. That is a maximalist objective and one that doesn't feel very commensurate with the idea of a peace deal.
Which raises the question what the larger context here is, what President Trump's nodes of leverage really are, and why Russia is inclined to push back and continue with this sort of geopolitical reordering where Russia is aligned more with China, with Iran, and pushing against sort of the American hegemony.
You know, the thing that's interesting, Lisa, and the thing that's confusing to me is just to see how different Donald Trump's approach has been toward Russia than to other countries like China and Iran. With respect to China and Iran, with both countries, he's trying to get a deal. With China, he's trying to get a trade deal. With Iran, he's trying to get a nuclear deal. And yet, while he's doing that, he's imposing major tariffs on China and big sanctions on Iran. With Russia, since January 20th, since Inauguration Day, there have been a grand total of 0 sanctions packages against Russia by the United States. And that is just a massive change from what we've seen over the last 3 years, where every month, even sometimes every week, there would be more escalation on Russia's economy. So I think it doesn't, Putin isn't crazy to think that, wait a second, there's something different about my relationship with Trump than the way Trump even relates to Xi Jinping. And so it's worth it for me to kind of hang tight and really just play for time.
Is there a geopolitical strategy that President Trump could be following by not imposing sanctions, by taking the tone that he's taken to try to engender some sort of agreement that could bring a halt to this war?
Look, I think that I understand if he wants to sort of preserve his position as an honest broker, and that maybe he thought that the Biden administration had leaned too heavily toward Kiev. So I do understand that to a certain extent. But, we're now several months into the administration. There's been several attempts at diplomacy. It seems like the U.S. has actually offered some significant concessions to Russia, right? There are reports that they offered to recognize Crimea, which I would remind folks, not even Xi Jinping has recognized Russia's annexation of Crimea. And yet Putin doesn't seem to be taking this seriously. And I think When I heard Trump say recently that Putin might be tapping him along, I think myself, as well as many other people who look at this issue, are hoping that Trump may be kind of seeing the light on Putin right now.
Let's talk options. What are the options available to the Trump administration, sanctions-wise?
Sure. So, look, I think one of the biggest myths out there is that Russia is the most sanctioned economy in the world. They're not even close. I mean, we talk about secondary sanctions, which would be sanctions on buyers of Russian oil, like sanctioning Chinese refineries or Emirati oil traders. That would be great. But let's talk about low-hanging fruit. Rosneft, the biggest oil company in Russia, is not under sanctions. Gazprom, the biggest gas company in Russia, is not under sanctions. These are primary sanctions. So, I mean, there are very basic things that we could do. And it's worth reminding folks that the reason this is the case is that Joe Biden was too cautious, frankly, in terms of attacking Russia's oil sector. And I'm hoping that Trump, with support from people like Lindsey Graham and Senate and House Republicans and Democrats for that matter too, who want to do this, will actually kind of get the chutzpah to actually take these kind of steps.
Where would that leave the Europeans?
The Europeans support this. I mean, the thing that's interesting is the Europeans have not been the big obstacle to energy sanctions on Russia. The issue the Europeans had, going back to even when I was working on this issue post-Crimea in 2014, 2015, the Europeans had been worried about sanctioning Russian gas, not Russian oil. But then Putin, in the summer of 2022, cut off the gas to Europe. He basically used gas supplies as a sanction against Europe. And so that ship has sailed by now. You know, the Europeans are on pace right now. They just certified a couple weeks ago that they're going to be totally independent of Russian gas by 2027. So right now, the question is really about oil, and it's really whether the Trump administration, with backing from Congress, is willing to actually attack Russian oil.
How related is that to the trip that President Trump is still on in the Middle East, making friends with everybody in the Middle East and really shifting the balance of power to that region, possibly at the expense of Europe?
Yeah, so look, I think that if you're going to be, empathetic with Biden, and the reason that Biden didn't want to do a frontal assault on Russian oil, the concern in 2022 was, you had massively tight oil market, right? You had oil prices that were above $100 a barrel. You had, really significant demand growth with rebounding from COVID. Right now, you've got Brent around 60, right? And you've got symptoms that the market is going to be oversupplied this year. You've got OPEC that's increasing production, looking like they're playing for market share. You've got non-OPEC supply that's growing. So right now, the market conditions, partly because of the diplomacy with the Middle East, are very favorable to start bringing some Russian oil off the market. And by the way, if we get an Iran deal, which is also looking more likely, that gives even more leeway to take 1, 2, even 3 million barrels of Russian oil off the market this year.
Not even the Democrats are empathetic with Biden right now. You notice that?
Well,
it's
yeah.
Enemy number one of the party.
Well, I think that there is a scapegoating and there is some mass revelation of what was seen and not seen by the public in terms of his deterioration. And I think that a lot of people are saying he didn't step down soon enough to allow Kamala Harris a fair shake and even just some sort of primary that could have been valid.
That's the argument, at least at the moment. We'll have more to say on that in the weeks and months to come, I'm sure. Eddie, it's good to see you, sir.
Yeah, nice to see you too.
Thank you. Thank you very much. Edward Fishman there of Columbia University with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Charter Communications is in advanced talks to combine with Cox in a deal that would unite two of the biggest U.S. cable providers. Sources telling Bloomberg the deal would be a cash and stock transaction that would value Cox Communications at more than $30 billion. An announcement could be made within days. And France and Spain and Greece are pushing for mandatory age restrictions for users of social networks, including Facebook and X. According to a document seen by Bloomberg, the digital services ministers from the three countries are coordinating on the proposal ahead of a meeting with their European Union counterparts. And the PGA Championship is underway at Quail Hollow. After the first round, Jonathan Vegas is in the lead at 7 under par. Meanwhile, Rory McIlroy and Xander Schauffele both struggled and will need a bounce-back performance today in order to make it to the weekend. That's your Bloomberg Brief. John?
Yahara, thank you. Terrible start from Rory just yesterday. Let's hope that changes. Up next on the programme, putting rate cuts on the back burner.
Fed looks to be in a pretty good spot in terms of keeping rates steady.
Maybe the discussion is that maybe even 2 cuts from the Fed is pricing in too many cuts.
The Fed will take it very easy here.
As long as the Fed can wait, they will.
Up next, Andrew Hollenhorst of Citi, live from New York. You're watching Bloomberg TV. Equities firmer here going into the weekend, up by 1/3% on the S&P 500. On the Nasdaq, we look like this, up by 0.3. On the Russell, up by 0.8. Under surveillance this morning, putting rate cuts on the back burner.
Fed looks to be in a pretty good spot in terms of keeping rates steady.
We're just pushing cuts further out in the year.
We see the Fed cutting only twice this year.
Maybe even 2 cuts from the Fed is pricing in too many cuts.
The risk to the downside in growth, I think, is real and present danger.
The Fed will take it very easy here.
As long as the Fed can wait, they will.
The Fed is going to be criticized for waiting. They have to wait.
It's the latest this morning. Traders pushing back rate cut bets as the Fed commits to a wait-and-see approach to policy. Andrew Hollenhorst of Citi writing, wait-and-see is the right strategy. The Fed can now more comfortably stay patient. And we're pushing for the next rate cut to come in July and not in June, as previously thought. Andrew joins us now for more. Andrew, good morning.
Good morning.
Question is, why go from June to July? Why July? Why the summer?
Well, I think it's just going to take the Fed seeing something in the data that makes them worried about what's going on with activity, what's going on with the labor market. If you look at the soft data, the survey data, it's been misleading in the past, but I think it's sending the right signal now. I think the hard data are going to turn. When the hard data turn, we'll have the Fed cutting. When exactly that happens, I don't know. But it could be July, it could be September, one of these upcoming meetings. I think
your best guess at the moment is July, which implies the weakening comes before July, quite clearly, which means you expect to see it in the next couple of months. What gives you that belief that's going to happen?
So I think we're going to start to see things in the job market, and that's really what's going to be important for the Fed. Of course, dual mandate, have to worry about inflation, have to worry about employment. We're seeing a low hiring rate in the job market. We know now from surveys, from anecdotes, that firms are pulling back further, if anything, on their hiring. We know we're going to have some government job cuts. We know that unemployment picked up last summer. So you kind of put all those things together. I think there's a good chance that we see that unemployment rate starting to move up again.
Why do you dismiss all the people who say that the jobless claims have been low? They haven't really ticked up that much. You've seen some of the credit card data highlight that people keep spending pretty much in a significant amount to the way that they did before. Why is that not a leading indicator for you at a time where there are very few kind of linchpins to truth along the way?
Yeah, I mean, I'm not dismissive of the fact that the job market has been pretty stable for the last 6 months plus. And 4.2% unemployment rate is not a bad unemployment rate to be at. I think the issue is that it's been stable, but it's been stable in a kind of fragile, uncomfortable way with this low hiring rate, with a low layoff rate. So you're not likely to lose your job, but if you do, it's hard to get hired again. And again, we have these factors that are probably going to be putting people into unemployment, harder for them to get hired again, and then you start to see that unemployment rate moving higher.
How do you gauge how much scarring there has been done based on the fact that we are at a higher tariff rate than we were at the beginning of the year, albeit much lower than it was, say, on April 2nd? Do you sort of communicate that the scarring is not that much less now than it was before the announcement that there was going to be a 90-day pause?
It's all a question about what's the point of comparison. I mean, to your point, if we compare this to when we had 145% tariffs versus China, there was effectively a trade embargo with respect to China. And then we were worried about really acute effects. Could you actually see less traffic at the ports, less jobs at the ports for that reason, less trucking jobs? Now it looks like probably that's not going to happen. So you kind of take out that extreme, acute downside risk, but you still have the uncertainty around tariffs. We're still uncertain about how this is all going to turn out, and that, we think, is leading firms to pull back on their hiring decisions.
The prospect of higher prices, Walmart basically saying we're close to passing on higher costs. The Federal Reserve needs to sit there in July and be convinced that any kind of inflation is not going to be persistent. Is that enough time?
You know, you can't wait until you have total certainty. I think that's a very general point that is important to make here. If you wait until you see all the data, by definition, you've acted too late. So the Federal Reserve is going to need to make a decision about where they think that trend in inflation is
Andrew,
going.
can I jump in?
Yeah.
Isn't that what they're communicating to us?
That is what they're communicating.
You just don't believe them?
I don't believe them. No, I don't think that you can wait until you have perfect clarity on the economy, because, John, you never have perfect clarity on the economy. You'd be waiting forever. They're not going to wait forever. They're going to look at that balance of risk. Look at the last two inflation reports. We have core PCE in the month of March, 0.03% month on month. In the month of April, we think it's going to be 0.13% month on month. So these are two really soft inflation readings. They follow two really strong inflation readings in January and February. But that cooling in services inflation, I think, should be giving them a lot of confidence.
It is a question I wish that interviewers would hammer Fed officials on. The difference between inflation being short-lived and more persistent. How do you know? And how long does it take to find out? How do you know?
Well, I think you have to make a judgment based on where that inflation is coming from and what the underlying drivers of inflation are. And this is why the current scenario is so different from what we experienced after COVID. After COVID, we had a negative supply shock to the economy. Supply was constrained, but we had a positive demand shock at the same time. We had lots of fiscal stimulus coming in. People could go out and spend. Now we're in a different scenario where you're getting the negative supply shock, but there's no positive demand shock happening. Wage growth is cooling. House prices have cooled. So you don't have that same inflationary backdrop.
Is there also the lack of belief in Fed Chair Jay Powell when he laid out in his speech yesterday that maybe the Fed would look back to their previous framework where they truly were targeting 2% inflation, not a range, not an average over a period of time, talking about how higher real interest rates may reflect the possibility that inflation could be more volatile going forward, that we could be in a period of supply shocks? Do you just dismiss that as something that they're not going to follow through with, emphasizing inflation even at the expense of the economy?
So I think they do need to think seriously about how you operate monetary policy in a world where you have these larger, more persistent supply shocks. That is a real issue that they have to contend with. Now, having said that, that doesn't just mean that you keep policy rates at restrictive levels at all time. You assess the current situation. And again, I think we're in a situation here where we have, yes, a negative supply shock that's going to reduce growth, that's going to raise inflation, but we don't have that demand shock to make inflation persistent, and that's what they should be paying attention to.
Do you think that they will take an average of PPI and CPI, look at that core PCE metric that you've just said is probably going to come in lower, and just extrapolate that out? Do you think that they're going to, even without some sort of pain in the labor market?
Yeah, I mean, you can't just extrapolate that out forever. I mean, you need to look at what are the details of that inflation reading? Where is inflation really going here? I think they're looking at shelter inflation that's slowing. They're looking at non-shelter services and wage growth that feeds into that have slowed. I think that should all be reassuring. The question is, what happens with goods? We're probably going to see some goods inflation because of those tariff rates. But that's where, getting back to John's question, that's where you say if the inflation is confined to goods, then we should be less concerned about it. That looks more like a one-time move in the price level. That's what Governor Lawler has said. I think he's about the only Fed official that's come out and said that.
Do you think they're close to making a mistake?
I think they could be. I mean, I think they do have time here. They do have the luxury of a labor market that's been stable, but you can't wait for total clarity. You'll never have total clarity.
The problem is, as you know, these mistakes are often born out of the conditioning from the previous experience. And that's why we had to wait last time around, because their experience was actually don't tighten policy too soon, which meant they waited and then inflation ripped away from them. They made a mistake. This time around, they're going to wait for different reasons, and they could make a different kind of mistake because they could have moved sooner the opposite way.
It could lead to a much faster deterioration in the economy, which is the reason why George Goncalves earlier was saying that they're going to be late and then they're going to move a lot faster. This is what a lot of people think. Right now in markets, we're baking in 2 rate cuts for the remainder of the year because the cuts are going to come on the heels of good data, of disinflation, not necessarily that pain in the economy that some people were worried about.
Andrew, it's good to see you, sir. Thanks for dropping by. Andrew Hollenhorst of Citi does not believe Fed officials when they speak. That's my takeaway. That's my takeaway.
In fairness, as we've said before, maybe he is conditioned by what we have experienced in the past as well. So,
true.
There is that.
If you fully understood all of that, and I hope you did. Up next on the programme, we'll catch up with Shalett of Morgan Stanley, MacGuinneas of the Committee for a Responsible Federal Budget, Congressman Mike Lawler on a big fight brewing in Washington over the SALT deduction, and Kelsey Berro of JPMorgan Asset Management. Live from New York, the second hour of Bloomberg Surveillance. Up next.
Every asset class is higher today than it was on Liberation Day, except for Treasuries.
It's a good idea to take a little bit of money off the table.
The market takes a pause here. I'm still comfortable being in risk assets.
It's not going to be a smooth ride.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now. Your scores look like this. On a 4-day winning streak on the S&P 500, looking to make it day 5. Equity futures on the S&P positive by 0.2%. On the Nasdaq 100 up by 0.2 also. A rip-roaring rally for big tech going into the weekend, and we'll build on that in just a moment. Also need to look for just a sprinkle of economic data going into the weekend. You, Mitch, consumer sentiment. How relevant is the soft data now after the trade truce over the weekend?
You know, this is going to be a real question because people are going to come out and say the University of Michigan sentiment survey is really messy. Nobody looks at it. And then it will come out and it will show some kind of either increase in inflation expectations or big decrease, and the whole market will trade on it. I mean, right now we're talking about a market with limited inputs. And so each one of them, even though people want to dismiss them, are taking on a life of their own. And I think that that was the message from yesterday's PPI print that suddenly has become the new narrative, even though people said it was backward looking and was going to be dismissed by the market.
The message from Walmart is that these consumers might be right to worry because in the coming months you might be seeing some higher prices.
The fact that Walmart said that gives the open door, gives the green light to other retailers to do the same thing. So this isn't just a Walmart story. This is the biggest retailer with the greatest ability to absorb some of these costs, both in their margins as well as pushing some of their suppliers to do the same and absorb the costs. If they cannot really offset some of these price increases, well, what does that say for other retailers? What does it say for mom and pop stores that don't have those same levers?
Which is why the Federal Reserve, many of these officials are just going to sit this out and wait. Wait and see is on repeat at the moment. The Atlanta Fed President Raphael Bostic catching up with Tracy Alloway and Joe Weisenthal saying he only sees one cut this year. One. And I think some people see zero. None.
Well, some of the people on the Federal Reserve and some people in the market, you've also seen the likes of Deutsche Bank move back to December, some of the first rate cut. I do wonder, though, how many Andrew Hollenhorsts there are out there who say we're conditioned by our experiences as well. And the Fed has said a lot of things that they've walked back. So, you know, when circumstances change, so do they. So we're going to watch the circumstances and they will follow.
Andrew does not believe what they're telling him. Doesn't believe it at all. He thinks this data weakens between now and the July meeting and they reduce interest rates by July. I have to say, look, for them to cut rates by July, you'd have to see a real weakening in the labour market data between now and then.
And that's the reason why people are watching not just what happens with trade deals that still have to get resolved. It's not as though this is the all clear, but also what happens with the budget. How much of a tailwind this is and how much of a headwind this is, whether it has to do with rates and the bond vigilantes or where it comes from budget cuts, in particular to states, either through the Medicaid cuts or elsewhere, that could potentially lead to layoffs and potentially a tightening in financial conditions.
There's always something to worry about. This market is worrying less this week. Equity futures up again, up by 0.3%. Coming up this hour, Lisa Shalett of Morgan Stanley as stocks head towards a solid week of gains. Congressman Mike Lawler calling for even stronger SALT relief, and Kelsey Berro of JPMorgan Asset Management on the biggest risk to the bond market. We begin with our top story. The president wrapping up his Middle East trip, securing $200 billion in UAE deals. Joining us now from Abu Dhabi is Annmarie. Annmarie, a week full of deals.
A week full of deals, and when it comes to the Emiratis, $200 billion, Jonathan, is the start. This story started in March. I reported about Sheikh Tahnoon having this meeting with the president in the Oval Office, and they were talking about trying to get as much as $1.4 trillion in investments with American companies. Yesterday, what we heard on this final leg of the president's tour, $200 billion. We're looking at aircraft deals, Etihad looking to buy 28 Boeing jets, oil and gas, traditional deals between Washington and the Gulf, ExxonMobil, Occidental teaming up with ADNOC, the Abu Dhabi National Oil Company. But then there was the star of not just the event, but I would say almost the trip. Jensen Huang has been on every single leg of this trip with the president, from Riyadh to Doha and then in Abu Dhabi, standing between President Trump and Sheikh Mohammed bin Zayed as Howard Lutnick signs this AI partnership between the United States and Abu Dhabi, looking to build the biggest U.S. data center outside of the United States right here in Abu Dhabi. It would be with U.S. companies. And of course, it'll be using advanced technological semiconductors from the likes of NVIDIA. Now, you have to see the Gulf is erupting in excitement about this, taking traditional oil and gas economies and looking into the future. We should caution a note, though. There are individuals, even within Trump's own administration, senior officials, wanting to make sure there are enough guardrails around these data centers that this technology, Jonathan and Lisa, does not get into the hands of Beijing.
Annmarie, great work this week. Safe trip back. I am surprised that this became a bigger week, not for the energy sector, but for the tech sector. To see these moves in chip stocks this week, to see these moves in tech more broadly, amazing.
The whipsaw of a bear market into a bull market with suddenly the biggest laggards becoming the biggest leaders as everybody flocks back to this idea of tech dominance in the United States really is head spinning. What I'm wondering is how long this can persist and whether it remains isolated in the tech sector or whether it really does broaden out to the rest of the U.S. universe.
An 8% rally on tech on the S&P 500 so far this week. Here's the word on Wall Street. Lisa Shalett of Morgan Stanley writing this. With equities having round-tripped back towards first quarter ending levels, markets are anxious to move on from tariffs and attempts to anticipate Fed policy. Lisa joins us now for more. Lisa, good morning.
Good morning.
How many times have we asked this question? Was it all just a bad dream? Can we just move on?
So, look, I think investors right now are weary and want to move on. They want to look through it. But I do think that things have fundamentally changed from the NASDAQ peak back on December 16th. I think the first thing that that has changed is it's really clear that top-line growth among the Mag 7 is decelerating. And growth investors typically don't like to see deceleration. The second thing is we're seeing this arms war with regard to CapEx spending continuing. If our latest update on looking at free cash flow yields shows Mag 7 free cash flow yields shrinking by about 11%. Typically, these stocks don't tend to do particularly well when their free cash flow yield is coming down. And look, we can pretend that the DeepSeek news doesn't mean anything. But we fundamentally think it was the wake-up call around global engineering, global innovation, and the fact that none of us know how the movie ends here on Gen AI, who the winners are going to be, how it's going to evolve, whether or not large language models very quickly become commoditized, and the next phase of the build-out is actually much lower data center intensity, much lower energy intensity, because it's very application-based. So nobody knows nothing. And I think right now, this is a market where we've had, a lot of positioning, technical positioning, where people felt, hey, I was caught off guard. This was a massive surprise. The effective China tariff rate is much lower than I penciled. I got to plow back in. You've got, some of the private wealth money and retail money coming in from the sidelines. But I think we're going to stall out here. I think it's just hard to justify the numbers. You round-tripped back to January 1st on market levels, and yet your earnings per share are down 6%.
So you'd fade this move?
I'm fading.
What would you rotate out of, and what would you rotate into?
Yeah, so, we're continuing to, recommend that folks take some profits in now the new leaders again, in tech, and really focus on the beneficiaries of deregulation. And so we see that as, financials, we see it as energy, we see it as, some of the healthcare names. I know for viewers out there, that's going to sound like a big value style bias, but quite frankly, it is. While we're not saying you've got to be overweight value, we do think you want value in this market because you want some risk premium. I mean, there are risks out there, and you want to get paid to be in this market.
What risks do you want a premium to be paid for? And this sounds sort of existential, but it goes to the heart of the question of, is it inflation, or is it recession, or is it both?
I think it's a little bit of both. I think we're somewhat less freaked out about inflation than perhaps we would have been if the tariff rates would have held. I think what we're worried about is that we're no longer in a forecastable policy backdrop, right? As much as we all want a hand wring about the Fed, for the last 15 years, Fed policy has been reasonably stable and reasonably well telegraphed. And there haven't been massive surprises. I think when we shift to a fiscal policy backdrop with this administration, as we've seen, it's very easy to experience both negative and positive surprises on policy. And that's what I want to get paid for, is that at any point, things can take a U-turn based on the headlines.
How much do the rest of the universe that you didn't mention, big tech that you're selling on the margins, or some of the financials and other value stocks that you're looking at that aren't exactly value, as you pointed out, how much do you think that it really will require Fed cuts to get the rest of the universe involved in some sort of positive momentum?
I think the rate cuts are absolutely, required for small cap, mid cap. I think that universe has suffered profoundly, from the higher cost of capital. By and large, the S&P 500, which is predominantly large and mega cap companies, have been pretty isolated. They have very healthy balance sheets, and for the most part, they haven't been inhibited by rates where they are, which is why we have multiples where they are.
Well, it raises this question, especially as the fiscal debate heats up in Washington, D.C., and you alluded to this. And there's a question about, as we find out how much the deficit is going to increase, how much bond markets are going to freak out, to use your sophisticated parlance. But there is this question of at what level in a 30-year, in a 10-year yield, it becomes prohibitive for stocks to really move higher from here, and it really injects some damage.
Yeah, I mean, look, I think for most of the last, 6 to 12 months, that, 450 on the 10-year, 4.5% on the 10-year, was kind of this stall out threshold. The market seems to be battling with it a little bit this week. But look, I think if we back up, if we get big deficit numbers coming out of this tax bill, and that 10-year moves into that 475 range, I don't see how the market, how equity valuations hold here. The math just stops making sense.
Lisa, it's good to see you, as always. Thanks for dropping by. Lisa Shalett and Morgan Stanley. Lisa, we're at about 475. 450, we bought that. We're back down to 440 on 10s.
Yeah, and this came along with the help of PPI data that really fed this idea of disinflation, and it came along with this idea that maybe there would be pushback to this bill. What's going to drive this market at any given day is as fickle as pretty much anything else. So, pick your data point, pick your narrative, and probably you can get some people to go along with you.
If the outlook for growth improves, you'd expect higher yields at the long end. The problem is those dislocations, and you talked about the speed of the move. If you get that fast dislocation in fixed income where you start to worry about where the buyers are going to come from, that's when people get nervous.
And if you start to worry about true dysfunction in the market, suddenly if you see things breaking, that further erodes some of the credibility of the U.S. markets, and that just leads to this additional question of what kind of risk premium you need on certain risk assets. And that's, I think, the bigger concern for a lot of people.
Certainly not seeing that this morning. Yield to lower across the curve. We're down by 2 or 3 basis points. The 10-year 440. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. President Trump saying he will set tariff rates for a number of U.S. trading partners over the next 2 to 3 weeks. He says Treasury Secretary Bessent and Commerce Secretary Lutnick will begin sending letters to about 150 nations that the administration doesn't have time to meet with, but he says want to make a deal. Meanwhile, Ukraine and Russian officials are meeting in Istanbul today to discuss an end to their war. But neither Russian President Vladimir Putin or Ukraine's Zelensky will be present. President Trump said just yesterday he doesn't think there will be a resolution to the war until he meets with Putin. And the Justice Department is conducting a criminal antitrust probe into how companies responded to mass concert cancellations during the pandemic. Sources telling Bloomberg the investigation is focused on whether companies Live Nation and AEG Presents illegally colluded on refund policies for canceled concerts. Live Nation has denied any wrongdoing. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the programme, fighting for a compromise.
The tripling of the deduction to $30,000 covers 98% of my district. Now, would I have liked a higher number? Sure. But it's not what you want, it's what you need.
Up next, MacGuinneas of the Committee for a Responsible Federal Budget. Live from New York City, this is Bloomberg. Looking for a fifth day of gains on the S&P 500 heading into the weekend. Equities up by 0.25%. The run on the Nasdaq, what a run. What a move for technology stocks through this week so far. Up by 0.3% this morning on the Nasdaq 100. Under surveillance this morning, fighting for a compromise.
Salt right now is roughly, it's about 215 billion. We want to stay within that piece. Now, that may mean we need to adjust the dials. The tripling of the deduction to $30,000 covers 98% of my district. Now, would I have liked a higher number? Sure. But it's not what you want, it's what you need.
Here's the latest this morning. Lawmakers saying negotiations over President Trump's tax bill will continue throughout the weekend as Republicans spar over the SALT deduction. Joining us again from Washington is Tyler Kendall. Tyler, just how far apart are these two sides heading into the weekend?
Yeah, hey, John. Well, far enough that it does appear that House Speaker Mike Johnson's deadline to get the entire House reconciliation package done by Memorial Day could now be in jeopardy. Because while you do have some of those Congress members like Nicole Malliotakis there saying that her constituents would support lifting this cap from $10,000 to $30,000, ultimately those other members from those high tax blue states say that's not going to be enough. And when it comes down to it, they're really the ones that are in this tug of war with fiscal hawks who say a $30,000 cap is already way too high. And it's those fiscal hawks who today, John, really do have a big point of leverage. They're threatening to sink an entire budget committee vote over their concerns about what all this means for a loss in revenue. And for context, the vote today, this is supposed to be routine. It's a procedural vote to basically bundle up all the different pieces of this legislation into one package and then move it along as quickly as possible. And to be sure and fair, these fiscal hawks, their only concern isn't just SALT, but also when it comes to the spending cuts, they're trying to pressure House leadership into moving forward when those work requirements on Medicaid could kick in. Right now, they're supposed to phase in by 2029. They'd like to see, in some cases, that move up to as soon as next year. And John, that really gets into the heart of one of the biggest disagreements here, which is that some of these members say there's too much of a front loading of tax policy in this bill and too much of a delaying when it comes to those savings.
Tyler, just quickly here, how many Congress members who you speak to go to a Bloomberg terminal and press USGG 10-year index GP? And I'm talking about the 10-year yield, and just understand exactly what it is at any given time in response to some of these budget proposals.
Well, I certainly will start asking them that question because that is a good one. But at this point, you know, of course, we have been talking about how all of this is going to have that longer term impact here. And I think you'll recall when Ray Dalio was here in March on Capitol Hill warning about the trajectory of the budget and what it means to basically take on what's going to be some pretty big deficit spending. And originally, lawmakers were really open to that argument. But then really this started to snowball as they tried to get all of these priorities into this one package. And at the end of the day, we're talking about disagreements in the House. But just wait until this gets over to the Senate. I've spoken to a few different lawmakers who say they're not going to vote for this package as it stands.
Tyler, thank you. I reckon Congressman French Hill knows his Bloomberg tickers, don't you? I think he's got them down.
He's a banker, tried and true, community banker. He knows those rates, and he's watching them very closely.
Joining us now to extend the conversation, Maya MacGuinneas of the Committee for a Responsible Federal Budget. Maya, welcome back to the programme. You've seen the policies on the table so far. The debate and negotiations continue into the weekend. Can you just put a number, a price of the policies on the table at the moment?
Oh, well, if they're talking about bumping up the SALT cap even higher than it already would be at 30,000, we are talking about massive amounts. Potentially $900 billion is what it would cost to bring it up to the 63,000 per individual that they're looking for, which, to put it in perspective, that is more than all of the new tax cuts in this bill. The no tax on tips and auto loans and overtime, all of those things. So this request to bring it above 30,000, which I will make the case is already higher than it should be, is an expensive one, and it could really cause the bill to fall apart.
Maya, you think it will cause the bill to fall apart. How much momentum is there, based on your conversations with people on the Hill, to really get the budget under control, given some of the deficit projections that have the fiscal deficit going to something like 6.4% as a result of the current proposal?
That is the really central question here, because all of the members who are trying to pass this do want to extend the tax cuts, and they do want to make good on the president's promises. At the same time, there is a large group that has been talking about fiscal responsibility for a long time. They were kind of under the impression that this would be a bill that would do both, extend the tax cuts and make the fiscal situation better. That is clearly not the case, though. And now that they're seeing the numbers, that a bill like this would add over $3 trillion to the debt. It would bring up deficits by more than $600 billion in the early years. Like, this doesn't hold together. And so the people who care about the fiscal situation, many of them talk about it, but the ones who worry about it are really, really having heartburn. And I am not sure they will be able to support this bill. From where I sit, worrying about budget deficits, they shouldn't. They shouldn't be looking at anything that would actually make the fiscal situation worse. Instead, they should be focusing on bringing the deficits down, which this would not do, no matter what the talking points are.
Maya, you've been worried about the deficit for a long time, and a lot of people have too, but you run an entity that really focuses on the fiscal deficit and how deep it's gotten over the past number of years. How different is this moment and this proposal in that trajectory in terms of worsening the deficit picture at a time when there's some people who are saying deficits can be fine as long as they bring in enough revenues to offset them?
Yeah, well, you asked the right question about the 10-year. Markets are starting to worry. The amount of debt that we are issuing really, as Ray Dalio and others are saying, could exceed what the appetite for lending us money is. And that would be a huge problem because if interest rates go up even a little bit, because we already have so much debt, those interest payments that we owe for it start to snowball. And that's where you get into a very serious situation. I think markets have wanted tax cuts and markets want fiscal responsibility. And the issue is nobody is willing to get behind the kind of savings, spending cuts that would allow those both to happen at once. So tax cuts are going to worsen the situation. Even if they generate some growth, which they will, it will not be enough to offset the huge amount of borrowing that comes with this bill. And nobody seems to be willing to put in place the kinds of spending cuts that would be required. Remember, the spending cuts that the House is talking about at $2 trillion is out of a pool of total spending over that same period of $86 trillion. So we are not talking about anybody who's willing to really put the savings in place that could bring the deficit down. That's made worse by adding to it with the big tax cuts.
Maya, can you think of a proposal that would be both responsible and palatable for House Republicans?
Well, first, I think they should focus just on TCJA, extending the tax cuts, not putting in a whole grab bag of new ones, particularly tax cuts that expire after 4 years. I mean, this is a bill where a lot of the tax cuts are put in place in the early years for 4 years, and a lot of the savers don't start until after this presidential term would be over. So it's very backloaded in the savings. So I'd get rid of those, and I would talk about that separately. I would say there's no room in the budget to do any of those new tax cuts until we put in place a debt deal. But secondly, they just need to look at a lot more savings, or they need to look at other ways to broaden the tax base. Ways and Means oversees $50 trillion. There are so many different areas of the budget that we can be talking about beyond just the savings that they've put in place. I would look at broadening the tax base, where the tax expenditures run through it. It's spending programs through the tax base. And that loses about $20 trillion over the next 10 years. So I'd go back to the drawing board. Incremental reforms are not going to make this structurally responsible.
Maya, appreciate your time. As always, we'll be speaking soon, no doubt. Maya MacGuinneas of the Committee for a Responsible Federal Budget. This conversation will continue as well. In just a moment, we'll catch up with the Congressman Mike Lawler, who's pushing for a much, much bigger number.
Yeah, he represents Westchester and parts of New York that have been disproportionately affected by that cap on the SALT tax deduction. He wants to see it go up further than that $30,000 level. How much he gets that is going to be a big question, especially given what kinds of cuts would be required to offset that in order to make Maya MacGuinneas feel a little bit more comfortable.
The Treasury Secretary, Scott Bessent, though, in some common ground with Maya, he has said repeatedly, consistently, that it's very important to extend TCJA, because if you don't, you're talking about a major tax hike that could trip over this economy.
Yeah, and you do that, and suddenly the revenue side of the picture goes down, and that doesn't help the deficit at all either. I mean, this is a two-sided picture, and everyone just has to keep that in mind as they look at this.
Maya said, look to the bond market. We'll look to the bond market. Yields are down by 4 basis points now. We've just broken 440 on a 10-year. No drama here just yet. 439. Up next, Congressman Mike Lawler calling for even stronger SALT relief. From New York, you're watching Bloomberg TV. We're looking for a fifth day of gains on the S&P 500 this morning. On the S&P, we're higher by 1/3%. A trade truce between the US and China, a lighter touch on AI chip exports, helping to drive a big week for tech stocks. We'll get to a few of them later in the program. The Nasdaq 100 up by 0.4%. Really interesting 24 hours in the bond market. All of a sudden, yields down from 450 to 440. On a 10-year, we break that level. We're down 4 this morning to 439. 42. Some disinflationary data, a tug of war between that and the prospect of a rather large tax bill coming together in Washington.
Yeah, for a hot second, crisis over, and now people are focusing on PPI. Does that change when we get the language from the tax bill? And there's been a real push-pull. Are the bond vigilantes still alive, or aren't they? Because ultimately, they seem to come and go depending on the day.
That's the long end of the curve. Front end of the curve anchored around this view the Fed's not going to cut rates anytime soon, reinforced by the communication from Fed officials themselves this week.
Wait and see, and this ability to do so at a time where the economy is still chugging along with retail sales not completely breaking down, although they were softer than many people expected.
The 10-year this morning's down by 3 basis points. The 2-year lower by 2 basis points to 3.94. That's equities and bonds. We need to get you some movers in the pre-market, so let's get to that. Your morning movers with Danny Berger. Hey, Danny.
Hey, John. We got some deals to work through. First of all, Charter Communications announcing that it would be merging with Cox, putting the two U.S. cable behemoths together. This would create, again, one of the largest offerings at a time that they're really competing with streamers, with wireless providers. The deal, they say, will help them compete more efficiently, build out more infrastructure, put bundles together. Cox, for its part, is a privately held company, but Charter Communications is public. Those shares up 9.4%. Some other deal news, this time among U.S. generators. Vistra will be buying 7 natural gas-fired power plants. We've seen a lot of deals like this year, and it really just underscores that these energy companies are trying to beef up their fossil fuel offerings, making a bet that that's what it will be required to power AI. Again, despite the fact that we had DeepSeek seemingly that it would lessen power generation or power demand, that has not yet happened. They are doubling down. Finally, I have Virgin Galactic. Look, I had to put this one up here. I know it's a small company, only $140 million market cap, but shares are up 17% this morning because late yesterday, the company said that it would be increasing ticket prices for its space tourism flight. It didn't say by how much. Current price is around $600,000 for a seat, so they're going to go higher. And John, maybe the good news is I don't think anyone has space ticket flights in their inflation basket.
There's your inflation right there, Danny. Thank you. Thank goodness for that. Danny Berger. Not a vacation any of us are going on anytime soon, right?
Well, I just think that single-handedly changes CPI. I think that we all should think about that. You aren't going to go to Mars?
No.
If you could?
No chance.
Come on.
No interest.
Play with the Martians?
Zero. I'd be very scared.
Of taking 9 months to get there and then
Speaking of
potentially 9 months.
airfares were down, right?
Yeah. That was one of the big inputs. Airfares on the heels potentially of gasoline, but also lower demand, which goes to the heart of just how strong is this consumer.
Interesting. A serious conversation in there somewhere. Good news. On a radar this morning, President Trump wrapping up his Middle East trip, securing $200 billion in deals during a visit to the United Arab Emirates. Trump also clinching $600 billion from Saudi Arabia and more than $243 billion from Qatar. Nvidia this week is up by close to 16%. 16% move on Nvidia this week.
Annmarie highlighted it well. The other person who was very much front and focus was Jensen Huang, who was enjoying the sword dancing and the camel parades and the hair flipping dance performances. And there was a sense that he was really being paraded through as the example, as the acme of American exceptionalism, and that suddenly he'd be able to offset any decline in chip sales to China with chip sales to the Middle East. Big question remains, as Annmarie was talking about, just what ends up happening when you do start to parse through how secure these chips are from the diffusion concerns or getting over to places like China, despite some of the strategic decoupling that we've heard about from Scott Bessent.
Jensen feels like the man of the moment, doesn't he? Doesn't attend the inauguration, went to China instead. All of a sudden, he's a feature of the conversation over in the Middle East, and it's Tim Cook of Apple that gets called out for all the wrong reasons.
Yeah, well, I keep thinking about Dan Ives, and he's saying, this sort of superstar rock star comes out in his leather jacket, and he's the future of a lot of the hopes and dreams of the artificial intelligence, of the algorithmic learning models. And President Trump has had sort of an off-again, on-again relationship with him. Now it seems to be very much on at the expense, frankly, of Tim Cook, who maybe is getting shafted with some of the goals of where they can move their production.
It's a big piece of the bull case for the equity market. Big rally in Nvidia this week. Big rally for tech stocks more broadly. Need to talk about foreign policy elsewhere. Russia and Ukraine beginning their first direct peace talks in over 3 years. Negotiators meeting in Istanbul. However, Secretary of State Marco Rubio downplaying expectations, saying progress is unlikely without a meeting between President Trump and the Russian leader, Vladimir Putin.
Yeah, and it's also unlikely without Russian President Vladimir Putin meeting with Volodymyr Zelensky of Ukraine. If they don't talk directly, if it is a low-level committee that comes to the table, it's hard to see whether they can get any kind of actual resolution. Just thinking back to what Eddie Fishman said, How much is there any will at all on the Russian side to get to a resolution, given the fact that they've taken a real maximalist approach and haven't really removed that or really backed away from that, even with some of the concessions that President Trump has made?
2 months ago, I think it was seen in the White House, and you could just see this based on the commentary, that Zelensky was the biggest obstacle to peace. That was the belief. I think Ollie did a pretty good job of articulating how things have changed over the past 2 months, and that Zelensky's doing his utmost to convince the White House that the biggest obstacle to peace is the Russian leader. The fact that we didn't get that high-level delegation attending talks in Turkey, does that do enough to convince the president that maybe he needs to go further and put on the big sanctions effort that the likes of Senator Lindsey Graham is trying to push?
And that's really going to be the ultimate question. And what happens if that's not the case? If it is the case, what does that do to this nexus that's being created of Russia, China, and Iran that has been one of the competitive features in the multipolar world that we keep hearing about?
This can change fast. The president, once again, wheels up for the Middle East, pushing again for a conversation potentially with the Russian leader and acknowledging without that conversation, it's unlikely we see any break to all the fighting we've seen over the last several years. I want to turn to this story, an important one for the tri-state area. New Jersey, transit engineers going on strike, disrupting travel for tens of thousands of commuters. It's the first rail strike in more than 40 years for the agency. The union representing engineers arguing for higher wages.
Yeah, 450 workers walked off the job. They are looking for higher wages. And there is the local feature of this. Are people going to take cabs? Are they going to drive? Are they going to work from home? Because why would they want to brave the roads in this type of circumstance? And then there's a bigger issue. And this goes to what we've been talking about this morning about states and their budgets and the budget constraints, particularly in blue states, particularly with some of the federal cutbacks. And I have to say, what Governor Phil Murphy of New Jersey said, I think, is important, that New Jersey Transit is facing a sobering fiscal reality. This maybe is a microcosm of some of the fights to come at a time where a lot of these municipalities are really strapped after having expanded their payrolls quite substantially over the past few years.
It's getting more expensive to drive into New York. If they want higher wages, it gets more expensive to get the train into New York, the bus, whatever you take, gets harder and harder, and it becomes more costlier.
Yeah, but at the same time, I recommend it. There are some good restaurants. There's some good theater. I'm just saying.
Is this a commercial for New Jersey to stay home or for New York to come into the city?
I don't know. I'm confused.
Which one is it?
Well, I'm born and bred New Yorker, so it is what it is. But I also do respect the fact that it's not congested. Look, I'm caring about the people who don't want to have that commute because it sounds miserable.
All right. Yeah. So work from home. So you push against Jamie Dimon.
No.
Is that what's happening here? Not trying to start fights. All right, let's go.
Let's get an update.
Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Today here, well, we start with a roller coaster week for Coinbase. The company was added to the S&P 500 earlier this week. Now it's facing a hacking and an SEC probe. The crypto exchange said hackers bribed its foreign employees to steal customer data and demanded a $20 million ransom, which it refused to pay. Coinbase is also cooperating with an SEC probe into whether it misstated its user numbers. Meanwhile, Richemont shares are rallying and Swiss trading up 7.3%. The luxury retailer posted a rise in full-year sales thanks to the popularity of its Cartier brand. Richemont's share price has posted a double-digit increase this year, while French rival LVMH has posted a double-digit drop in the same period. And the San Francisco 49ers have reached a deal to sell a roughly 6% stake in the team at a valuation of about $8.5 billion. That breaks the record for a sports franchise that was set in December by the Philadelphia Eagles. The buyers include 3 private investors in Silicon Valley Venture Capital. The deal will require approval at the NFL owner meeting. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on this program, Congressman Mike Lawler calling for even stronger salt relief. That conversation just around the corner from New York. This is Bloomberg. Equity futures looking at a 5th day of gains on the S&P 500, up for 4 days through Thursday, up again this morning, up 1/3 of 1% on the S&P, on the Nasdaq, up by 0.3, on the Russell, up by 0.6. Turning from markets to the nation's capital, infighting between House Republicans threatening to delay a much-anticipated tax bill. The key issue, salt cap increases. One man at the centre of all of that, among others, Congressman Mike Lawler of New York. The congressman joined us now from Capitol Hill for more. Congressman, welcome back to Bloomberg Surveillance, sir. It's good to see you again.
Thanks for having me.
Let's talk about progress made this week. Speaker Johnson keeps saying we're getting closer and closer. What's your assessment of how much progress we've made so far this week?
Well, finally this week, we had the opportunity to sit down and go through real numbers and start to have a negotiation. And I think that was long overdue. We had been pushing for months to have that conversation with the Ways and Means Chairman, with the Speaker. So we finally began that process. And obviously, this is something that's going to have to be negotiated over the weekend to get to, hopefully, an agreement when it comes to the issue of SALT.
We understand the proposal, a tripling of the deduction to $30,000. Could you give us a sense on how far apart you are right now?
Well, there's a number of issues. Number one, the marriage penalty and eliminating that for those filing jointly. Number two, there is real concern about reverting to a $10,000 cap, which none of us support. That is a real challenge. Number three, the fact is these income limits are a problem. 400,000, while it may sound like a lot in some areas, in an area like mine, that's a cop and a teacher who are married and have a combined income. So the fact is, we have high property taxes coupled with high income taxes, and you'll blow right past the $30,000 cap without a problem. You look at my district, 3 of the 4 counties that I represent are in the top 16 highest property tax counties in America. And so there's a real issue here in terms of the numbers. And so we're working through it. I've read The Art of the Deal. I'm not going to negotiate in public. But the fact is that, we need to make some significant concessions to get to a number.
Congressman, what would you like to see cut to offset some of the increases to the SALT tax deduction? Because ultimately, the SALT cap, because that's a real concern right now for markets, is how much does that alone increase the deficit?
Well, a few things. Number one, any cap is a savings, okay? Because the fact is that the cap on SALT expires at the end of the year. So we are actually giving them a pay-for by agreeing to a cap. That's number one, and people should recognize that as part of these negotiations. Number two, there's a number of levers that can be dealt with here in terms of savings versus adjustments within the tax code. That's what we're talking about. We're waiting to hear back from the Speaker and then be able to make a honest determination as to what we can get to.
There's also this issue, Congressman, that as this debate has raged on, there's been an argument that you have pioneered saying that moderates make the majority for Republicans and that you need to be able to punch above your weight because without you, they wouldn't have the position that they actually have. How much is this sort of setting the stage for what's to come? How much do you see this as a theme that we're going to hear about quite a bit as we head to the midterms?
Well, listen, we have a 220-seat majority and 3 of us won districts that Kamala Harris won. You lose the 3 of us and you're in the minority very quickly. Look, I think the reality of this is math. And I certainly respect all of my colleagues. They're all here to represent their districts, as am I. And my district has different needs than some of my colleagues who are in safer seats, who are in more Republican seats. That's just a reality of life. And so to me, this is about compromise. None of us are going to get everything we want in this bill or any bill. But all of us have to find a way to work together to keep the majority and make sure that we're delivering for the American people and our districts. And that's what I'm doing in fighting for this issue, fighting to protect Medicaid. I have one of the highest, a district with one of the highest number of recipients of Medicaid. There are people who rely on these critical programs, and I'm doing everything I can throughout this process to protect that, including blocking any changes to FMAP, per capita caps, block grants, dish cuts. We've been able to do that throughout this process and make sure that those who rely on these programs receive the benefits that they need, while making sure that we eliminate waste, fraud, and abuse, prevent illegal immigrants from receiving Medicaid benefits, make sure that able-bodied adults without dependents are working or going to school, and making sure that those who are no longer eligible are not continuing to receive benefits. Those are common sense reforms that the vast majority of the American people support.
Congressman, you mentioned the art of the deal. Let's talk about the author of the art of the deal. The president's on his way back to Washington. Do you have plans to speak to him? And do you have a decent sense of what his position is?
I will be reaching out to connect with him for sure. I think he obviously had a very successful trip in the Middle East, brought back significant investment into the United States in agreements with Saudi Arabia, the UAE, and Qatar. And that obviously bodes well for the American economy as we move forward. So this was a great trip for the president as chair of the Middle East and North Africa subcommittee. Certainly, I'm looking forward to getting a readout of more details on what occurred on the trip. But I think it was a big win for the president, and so he comes back obviously on the precipice of getting one big beautiful bill passed. And so we have a little bit of work to do still, but I think it's been a very good week for the president.
I know you've been up all night. I just wanted to squeeze in one more question that I think is relevant to a lot of our audience. You've co-sponsored the Trust in Congress Act, to ban stock trading in Congress. Can I just say, Congressman, we all find it absolutely ridiculous that people in Congress have looser regulations, restrictions to trade stocks than we do as financial journalists. Congressman, can we actually do something about that sometime soon?
Look, I'm in full support. The fact is, you're here to serve. If you want to make money, leave. This to me is a very common sense reform to make sure that members of Congress or their spouses, we've seen some spouses who are prolific traders, in recent years. The fact is, they should not be benefiting from inside knowledge or information gleaned from meetings they have, committee hearings they hold, or legislation that is pending. And it's just a reality of life that anyone in this position is provided with more information than the average person.
Yeah.
And therefore, it is imperative to make sure that members of Congress or their spouses are not benefiting from that information, and all of their assets should be put in a blind trust, period.
If they're that good at trading, they should start a hedge fund. Congressman, appreciate your time,
Exactly.
sir. Going to have a busy weekend, I'm sure. Let's hopefully catch up again soon. Congressman Mike Lawler there on the effort. Lisa, down in Washington, D.C.
Yeah, many efforts, including that to potentially get some trading regulations in place. I do think that the effort when it comes to the tax bill is going to be absolutely incremental, and it's going to be incremental for a lot of people in the market.
Kelsey Berro of JPMorgan's with us. He's got this to say. The biggest risk to the bond market in the near term is the budget trajectory and the reconciliation negotiations. Kelsey, your thoughts on what's taking place down in Washington?
So the market is laser focused on these negotiations. And it's not just, we were hearing about the fight within the Republican Party on the SALT deductions, but there are a multitude of groups that have issues that need to be addressed to move this forward. And as you rightly mentioned, Lisa, adding to the SALT deductions is another thing that is a cost that increases the deficit. Regardless of the counting around it, it's something that is giving a tax break to people. And so from a bond market perspective, everybody wants to know about what are going to be the pay-fors that we're going to be looking at. And I am encouraged by the fact that if I look at the price action today over the past few days, we have been able to stabilize below the 450 level, which was our range going into it. 375 to 450 was our range for 10s. We have been able to stabilize there. But the bond market is certainly on edge on this topic.
So there's this sort of push-pull right now because a lot of people have come on the show and said if they're worried about recession, they're worried about some sort of negative growth shock, that they're going into treasuries, that they think they're getting paid for it, even though they understand some of these existential worries. How do you negotiate that for your own bond portfolio? Understand what that risk premium is for fiscal concerns.
The term premium has to be higher. But I will say that I do think a lot of this is already priced. When I look at the 30-year yield nearing 5%, I do think that a lot of those concerns are somewhat already priced into the market. And when I really think about, where is fair value for Treasury yields, and you build out a model, once you adjust for the path of growth and inflation, the level of debt supply and deficits really isn't a driver, at least historically, for the level of Treasury yields. So in other words, we've had times where yields are higher when we had budget surpluses, and we've had time where Treasury yields are lower where we've had budget deficits. So ultimately, when you think about the budget reconciliation, it's not just the deficit itself, but is there a growth and inflation impulse that's going to impact the economy and impact the Fed's reaction function?
And that's the reason why people say this is slightly different, because we increase the deficit during a time of expansion, not necessarily contraction. So that's different than usual. Is there any budget that could come out of Washington that would make you say, I am not buying unless we get above 5% on that 30-year?
That's a pretty difficult question. I honestly think that there is still quite a lot uncertain in terms of what we're going to get out of the budget. Sure, yeah. Hypothetically, there is a situation where the plan is just so reckless that the bond market has to come in and really police the market, right? But kind of turning to what we expect and what is out there right now, I think what we have is a scenario where yields are already quite high. They're compensating you for an expansion in the deficit. And I think what has changed, because bonds, we do feel, continue to have a place in your portfolio. Now, what has changed is the narrative around why bonds fit. So a week ago, when we were in a scenario where there was high tension between U.S. and China, effective tariff rate of 20%, recession was the base case, people saw bonds as an attractive hedge in their portfolio for a hard landing where the Fed is cutting aggressively. Now we're in an environment where, well, maybe the Fed isn't cutting, they're on hold, yields are more range-bound, and the place of bonds in your portfolio is returning to really where it was at the start of the year, which is high income, clipping coupon. Credit fundamentals still seem actually quite healthy. When we stress test our companies for a 10% tariff regime, 20% tariff regime, we're still ending up in a place where investment grade corporates have low single digit earnings and revenues. So back to a world, at least for the short term, where bonds are providing that income stability, clipping coupon again.
The debate continues. Is it fiscal stimulus or fiscal recklessness?
I think we'll have to just wait and see, and I'm not going to answer that question because who knows?
Kelsey Berro at JPMorgan. Kelsey, thank you.
Thank you.
Appreciate it. Up next, Alex Altmann of Barclays, Aneesha Sherman of Bernstein, Kathy Bostjancic of Nationwide, and Stephanie Larosiliere of Invesco from New York City. This is Bloomberg.
Certainly by the fall, I think we will start to see the impact of slower growth.
Stagflation is an increasingly bigger concern.
Chances are, with what we know, lower inventories, fewer selections, and higher prices.
Dislocation between the soft data weakening and the hard data kind of muddling along.
There's a big gap between confidence, sentiment, and the results.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
A trade truce with China and the United States of America. Lots of deals in the Middle East unleashing a big rally in this equity market. On the S&P 500, 4 days of gains. This could be day 5. Equity futures and your scores look like this. Equity futures up by 0.3% on the S&P. On the NASDAQ 100 up by 0.4. Tech on the S&P this week higher by 8%. 8% in 4 sessions. Amazing. Your day ahead looks like this. A little bit later this morning, we get another read on consumer sentiment going into the weekend. The next week is dominated by retail earnings, Target, Home Depot. But I think this weekend, take a beat. Negotiations down in Washington, D.C. on the tax bill. All of a sudden, the tax bill has taken center stage.
And we saw that briefly when the 30-year yields really bumped up against that 5% level as people parsed through just how much the tax bill would increase the deficit. It is unclear what's going to get through. It is unclear what it's going to look like. It is unclear just how much the bond vigilantes are going to look at this. But you asked a question, and I didn't answer it. Is it going to be a tailwind or a headwind? Is it going to be a stimulus, or is it going to be something of a fiscally irresponsible drag on the bond market? And that ultimately is the question people are looking to get resolved.
How it's viewed is really important. If it's viewed as fiscal stimulus, take foreign exchange. That's currency positive. If it's viewed as fiscal recklessness, foreign exchange, that's currency negative. Which one is it at the moment? Because we've been ducking and diving between one and the other repeatedly over the last several weeks.
And I think a lot of this comes down to just how much the bond market's going to fund. Because if you have yields going up that makes it more expensive to fund the fiscal expenditures, then all of a sudden it looks a little bit more reckless and less sustainable. If yields behave and they can get something through, then we are in the similar kind of paradigm as we were before. So really it goes to a question that you have asked so many times before, which is how long will the U.S. have the privilege of acting recklessly? And that, I think, is a real question that the bond market's going to have to answer.
The Congressman Mike Lawler not too concerned about that right now. He's pushing for even more. The president's going to return to Washington. I imagine the president's going to have something to say. He wants his one big, beautiful bill. Who's he going to support?
Honestly, this is going to be a real key question. And right now his focus has been on Jensen Huang and going to the camel parades and the sword dancing. Have you seen any of these spectacles? I mean, have you seen the hair flipping dances?
I don't know what I thought about some of those dances.
Oh, yeah?
Yeah, I found them a bit uncomfortable. I'm not sure how I would have responded if everyone was around me dancing in quite the same way they were dancing around the president.
Well, there was a pretty big distance, if you noticed, between them, particularly with the sword dancing. I will say, though, that there is this push-pull, and when it comes to the budget, this is the issue. Like any company, you've got two sides of a balance sheet. You have the income and you've got the expenditures. And right now, how much do you sacrifice the income side, slow growth, to really curb some of those expenditures?
I assume they're master swordsmen. The president's a good sport. I think he was entertained by it all.
I think it was fascinating. I would have enjoyed that. You know me. I would have been on a camel myself, out to camp in the desert. I would have loved it. It would have been really fun.
It's very you. This is what happens when we go to Jackson Hole together. What does Lisa do? Lisa goes hiking.
Yeah.
Goes out in the kayak.
You pull away and say why.
Running away with bear boughs and, you know.
You've got bear spray.
And all of that,
it's really going to the lodge.
Not going there this summer. Equity futures on the S&P, positive by a third of 1%. Coming up this hour, Alex Altmann of Barclays as stocks look for a fifth day of gains. Aneesha Sherman of Bernstein on a key stretch for the consumer. And we'll catch up with Kathy Bostjancic in just a moment of Nationwide on the divergence between hard and soft data. We begin this hour with stocks heading towards a week of gains. Alex Altmann of Barclays writing, not everyone is back in the ocean, but perhaps ankle deep and the water feels nice and warm. Recession has moved firmly to the back burner. Alex joins us now for more. Alex, good morning. Good to see you.
Good morning.
You weren't alone, so I'm not picking on you. But the trade truce between the US and China seemed to catch a lot of people off guard. And all of a sudden, to start this week, it's like tariffs is yesterday's news. It's all about the tax bill. What do you make of that shift?
So I think, well, as you said, we got it wrong, and we're happy, not happy, but we'll admit that, like a lot of people did. I think the bottom line is that we're now moving so quickly from narrative to narrative, and it's moving so quickly that positioning can't keep up. And I think this really is the critical theme to think about in markets at the moment, is that narratives are moving, I'd say, every 2 weeks. If you think about the size of hedge funds, the size of gross balances, how much money needs to get moved around from a long-only community, there is just a scramble as risk tries to flip-flop between, say, being very defensively positioned to now being like, okay, do I want to be more cyclical positioned, or is the economy now going to be in better shape? And as we move towards this trade discussion, then it's all of a sudden the jump goes from, okay, are we going from fiscal contraction to expansion? If I look to 2026, if all of a sudden, do we actually now want to start talking about GDP being better than expected and earnings all of a sudden, okay, 290 of S&P earnings in next year, and I'll put that back on a peak multiple, 2024 redux.
That word risk, we need to define it. Lisa asked the question earlier on in the programme. When we talk about risk, what kind of risks are we talking about? When you consider the hierarchy of concerns, what was it 2 weeks ago and how has it developed in the last 2 weeks?
I mean, great question. So we actually conducted a survey on this at the beginning of April, middle of April, and then we reconducted it just 3 weeks later, just to sort of gauge it. So as you would imagine, 3 weeks ago, top of concerns, tariffs, left, right, and centre. And now we conducted it again this week, top of concerns, inflation and rates. So it's really just flipped again dramatically, that narrative from putting tariffs on the back burner, which I find a little bit discomforting purely because these tariffs are all on a 90-day delay. And sure, we could make the case saying, well, actually, the 14% effective tariff now effectively is a ceiling, and we can get positive on that. But we're going to have to return to that narrative. So even though the top of those concerns right now is the fiscal dynamic, I'm pretty sure in 3-4 weeks' time, which I know is an eternity in this market right now, we will be returning back to the tariff narrative once again.
You've been in macro trading a long time. At what point do people look at this sphere and they say, you know, I don't think I'm going to go in the water at all, because every time that I go in, there's going to be a shark that comes out from somewhere and try to get me. And it just sort of feels like you're going to get whipsawed one way or another. How much of an edge can you actually get?
I think it's a very good question, and by definition, a lot of macro traders are having difficulty right now getting whipsawed from that positioning extremity, moving from one to the other. But the bottom line is that we're in the business of taking risk. We're in the business of trying to make money from trading the ebb and flow of these narratives. I think what's really changed, though, and it's the only thing that's really changed, is that the cadence of that narrative shift has changed as a function of that vol profile. So all you're really doing is you're just going to shrink down the size of those bets a little bit, but you're still going to place those bets and just be mindful and attuned to where that consensus moves quickly, and you probably want to start taking your risk off the table when consensus moves too quickly, which, by the way, I think is exactly where we are right now.
Which is the reason why so many people have come on the show and said they're going to lighten up in big tech just a little bit after this rip-roaring rally, as John was mentioning, 8% just in this past week alone. This feeling that what we've seen in the Middle East just dissolves all of the concerns around some of the slowing revenue growth by some of the tech giants. Do you think that that is kind of the way to go, given some of the developments that we've seen?
I'd say you have to think about very tactically in terms of, look at a lot of these big tech, they've got very high RSIs in the mid to high 70s now, rallied 8% on the week. But you've also got to remember, we've discussed this on the show before, the liquidity mismatch between big tech and basically everything else means that ultimately, if you want to redeploy capital into equities again, that's going to be your default source. Not just because these are quality businesses, and that's actually a stylistic preference that we like at the moment, which is pro-quality, which includes some of big tech, but also just because if you need to deploy billions of dollars quickly, yeah, sure, you could trade futures. But at the same time, if you want to deploy it into single stocks, you're limited. You're going to end up with some of those big companies as well. So they just so happen to check the box of that 2024 redux of higher for longer, economies slowing but positive, and quality balance sheets. And you're going to shun basically S&P 493. So yes, tactically, you could say it could take a pause, but we've got the NVIDIA results coming up, obviously, at the end of the month. We've got AMD Analyst Day. We've got updates from OpenAI. So there's still positive catalysts on the AI front, which I think people are going to get enthused about until they run into a reminder that tariffs is still a threat, I think, sometime in June.
I've heard you make this liquidity argument before. Can we just build on it with one further question? Is that your argument to play the US over Europe? Is that the argument that you're making?
So, as you remember, beginning of the year, we were very much non-US over US. US exceptionalism is waning, and we sort of very much went on the record with that. We took profit on that view in the middle of March because it just moved so quickly. Now, actually, tactically, I think there is an opportunity for that to reverse. Again, we have to work off 2 to 4 week time horizons right now. That really is the operating time horizon, sadly, for the investment community within my world at the moment. So if we're thinking about next 2 to 4 weeks, then yes, absolutely. I think there is an environment where the US exceptionalism trade can just make a little comeback. That obviously has profound implications for the dollar as well, in terms of the world is almost unequivocally and universally bearish on the dollar, which actually could take a hiatus too. And that in turn has implications for where did money flow into as part of the de-dollarization trade? Well, that would be gold. So we're actually quite negative on gold here as well.
Just tactically, though, not necessarily long term, all tactically. I am curious, though, about whether Europe will be the big beneficiary of some of the loss of American exceptionalism down the road, should that be the case. Right now, it might be a tactical pause in that trade, or whether it's going to be emerging markets, whether it's going to be other places that might see a bigger gain than, say, Europe, that has some very specific challenges right now as well.
Well, Lisa, you know we've actually been pretty constructive on just trying to be more creative and looking in the rest of the world. Again, with that liquidity acknowledgement that it's going to be difficult to necessarily deploy the kind of capital that you're used to deploying in the US. But as you know, yes, there's pockets of emerging markets that we've liked all year and still do like, most notably LATAM, which is still trading very cheap, has, I think, interesting idiosyncratic tailwinds. And places like Mexico, which I've mentioned before, is just the natural beneficiary from the readjustment of global trade. In Mexico, great geographic border, lower transportation costs, very good labor costs, and still trades at a very good valuation discount.
How do you want to manage the FX risk, given what you're anticipating in foreign exchange with the US dollar?
Well, look, I'm not going to pretend to be a complete FX expert, but I do think that
no one is these days, Alex. Don't worry about it.
Well, I think what we've seen in things like the Taiwan dollar, the Korean won, I think we've got to accept the fact that there is an adjustment in global FX going on. Let's not call it a Mar-a-Lago Accord, but let's call it something like an acknowledgement that there needs to be an adjustment process. But again, if you're trading from an FX hedge basis, some of these domestic ETFs that are effectively giving you country exposure, you're already getting the benefit from a readjustment in the currency there as well.
Alex Altmann of Barclays, thank you, sir.
Thank
Good
you
to see you. I know that sounds like I just threw a lot of shade at foreign exchange and people in foreign exchange. Just want to make sure people understand. When we came into the year, we thought the trade story would result in a stronger dollar. Myself included, no one expected the kind of currency weakness off the back of those policies in quite the same way we got it.
Nobody expected decade-long moves in the span of just a couple of hours, whether it was the Taiwan dollar, whether it was the euro suddenly reprising a role as something of a haven currency and then losing it again and then gaining it again as people try to figure out what the alternative was to the dollar. Suddenly, gold is taking on a whole life of its own. I mean, honestly, those bars that you bought in Costco, really working out. I think it's good. I think that you should, definitely keep them.
I don't own any gold. I wish I had done over the last several years. Gold is down by 2.3% so far this morning. Equities up nicely, up 1/3% on the S&P, adding to this week's gains. On the S&P 500, higher by more than 4% on Nvidia. Alex mentioned Nvidia. Nvidia higher this week by more than 15%. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. Republican infighting in the House is threatening President Trump's one big, beautiful bill. The biggest issue, the SALT cap. A group of lawmakers from high-tax states, including New York and New Jersey, vowed to vote no on the package unless the cap is raised or abolished. Lawmakers have said they'll continue to negotiate throughout the weekend. Meanwhile, New Jersey Transit train engineers went on strike at 12:01 a.m. this morning, leaving tens of thousands of people looking for other ways to get to work. The walkout comes after the latest round of negotiations failed to produce an agreement. It is New Jersey's first transit strike in more than 40 years. And Novo Nordisk CEO Lars Fjorgard Jorgensen is stepping down. His resignation comes as the drug maker struggles with growing competition for its obesity treatment, Wegovy, which has weighed on the share price. According to a company statement, Jorgensen will remain in his post for a period to support a smooth transition to new leadership. That's your Bloomberg brief. John?
Yahara, thank you. We'll touch base with Yahara again later this hour. Up next on the programme, the morning calls, plus Aneesha Sherman of Bernstein on a big week for the consumer. From New York City this morning, good morning to you all. You're watching Bloomberg TV. Stocks are higher every single day this week, and this Friday we're looking to complete the streak. 5 days of gains potentially on the cards going into the opening bell. That cash open is 1 hour and 14 minutes away, with equity futures higher by 0.4% on both the S&P and the Nasdaq 100. On the Russell this morning, small caps higher by 0.7. That's the price action. Let's get your morning calls. First up, Canaccord raising its price target on Netflix to $13.80, citing progress in developing its ad business. That stock is higher by 0.5%. Your second call from UBS, upgrading Caterpillar to neutral, highlighting better than expected progress in US-China trade talks. And finally, Telsey cutting its price target on Target to $130, pointing to soft consumer spending trends and tariff pressures. A stock is up this morning. It reports next week. Let's stick with retail. A slew of companies reporting earnings next week, including Target, as tariff uncertainty weighs on outlooks. Aneesha Sherman of Bernstein joins us now for more. Aneesha, welcome to the program. Already a big week for retail. I want to start with that quote that came from Walmart yesterday. We will do our best to keep our prices as low as possible, but given the magnitude of the tariffs, even at the reduced levels announced this week, we aren't able to absorb all the pressure, given the reality of narrow retail margins. Aneesha, that's how they're approaching this situation. How's the rest of retail approaching this situation?
Yeah, very similarly. So when we first got the news of the tariffs, what we saw was from January through March, every supplier, retailer, brand was trying to pull forward inventory to try to get ahead of that April 2nd deadline. So we saw a surge in imports. because they were trying to delay the inevitable price increase by kind of stocking up on inventory. Those stocks have now depleted. And we are now seeing the effects of the tariffs coming into imports. And so now is when we're starting to see the pricing pressure come in. We haven't seen it yet. And no brand that I talked to wanted to be first out. Nobody wanted to be the first mover on raising price. But we've now seen all the way from luxury goods brands talking about 10% price raises down to Walmart talking about pricing on discretionary goods. So up and down the premiumization tier, everybody's talking about price increases. So it gives more permission for brands to do so. And we've heard from multiple brands, including Nike, Adidas, On, as well as many of the retailers talking about inevitable price increases coming because they are now no longer the first movers and they see this pricing umbrella within which they can move up as well.
Aneesha, why are they so worried about being the first mover? Why is this so different this moment compared to what we saw coming out of the pandemic?
The difference is consumer demand. So coming out of the pandemic, if you remember, people had excess savings, right? They had stimulus checks that they'd been given in 2021. And so in 2022, savings rates were still pretty high. And there was excess savings out there. People were eager to spend. They'd been locked up in their homes for 2 years. They were eager to get out there and spend money. So there was a lot of tolerance for price increases then. And there were a rollout of a number of different price increases because of freight costs and labor costs, et cetera. But the consumer absorbed that. This is a very different demand environment. The consumer is much more sensitive. Consumer sentiment has dropped since February and continued to come down. And we're worried about inflation. So this is a very different consumer macro to be raising prices into. And that's the concern, is that the price increases will result in a big drop off in volume, particularly if you are the first mover and your competitors aren't doing it.
Aneesha, how much does this really cap how much these companies can increase prices? And I go back to 2001, 2021, 2022, when you were seeing 10% increases on a lot of goods across the board. How much is it going to be different in terms of the magnitude this time?
It depends a lot on the individual sector. So, for example, within apparel, footwear, handbags, many of those sectors, China is not a big production market for the big brands. It's Vietnam. And so if the Vietnam and Southeast Asia tariffs stay at plus 10%, there really isn't going to be a huge need to increase prices in the double-digit range. However, for many sectors where China is the primary market of production, so some of the hard goods, home furnishings, many of the plastic products, toys, et cetera, you do see, I mean, if your majority of production is in China and the majority of your global sales are in the US, there's really no getting out of this through supply chain shifting. So you kind of have to pass on or absorb a lot of that increase. And for many of the suppliers, you can't absorb a lot of it. As you said on the Walmart quote, they're running on pretty thin margins. So a lot of that does have to go onto the consumer.
If it doesn't, Aneesha, or if it does go onto the consumer and then the consumer just buys less, how realistic is it that some of these companies, these retailers, are going to have to cut staff, are going to have to look for cost cuts elsewhere in the company?
I don't think it will be the big retailers. It really will be the suppliers of those retailers. What we're hearing from the industry is these big retailers are pushing back on their suppliers, saying, you guys need to find a way to offset a good chunk of this. We're not going to be able to pay higher prices. So you're going to have to bear the brunt of this. And those suppliers are small and mid-sized businesses with majority of production in Asia, a lot of them majority of production in China. So they are scrambling to try to find alternative supply chains or trying to find ways in which they can offset that cost. So that's where I think we will see some of the companies both falling out of the market, bankruptcies, as well as losing staff, cutting back costs, et cetera. I don't think it will hit the big retailers first. They will squeeze their suppliers before that.
Let's build on some of that. How much dispersion do you expect in the sector in the next several months? What do the winners have in common? What do the losers have in common?
Great question. What we typically see in times of disruption like this is there is more dispersion and there's share consolidation. So the big companies that are well capitalized, that have strong balance sheets, that can get through a period of pain and lower volume emerge, and the smaller ones that kind of can't make it work and don't have a very strong balance sheet either tend to cave and completely go out of business or tend to cut back. And that is, I think, what we will see if we continue to see this pressure, especially if we see inflation ratcheting up and the consumer pulling back on volume, is we're going to see a consolidation in the market, and the bigger players will be the winners here. The other factor is, as I said, category exposure and where the tariffs land. It seems like it's disproportionately China at the moment. If that remains the case, then sectors that are not absorbed to China will come by quite easily, whereas the ones that are absorbed to China will get really squeezed. And that's where we'll see some of that consolidation and losses and jobs and things like that.
Can I ask more directly where a company like Target might fit in? Where would they fit in, looking ahead to next week?
Yeah, I mean, I think given that Walmart has now been the bellwether and saying they're going to raise prices on discretionary goods, but not on food, I think that's the way a lot of the retailers are going to go, because food is that's what gets people in the door. That's where the lower income consumer is looking for price as a signal of value. And so I think retailers that have food and non-food offerings will pass more on the non-food. That's where they're getting higher costs, and they will keep their food prices low and maybe subsidize that through the non-food pricing. That's, I think, what we'll see for some of these earnings coming up.
Just to finish on Target, are you expecting any inventory landmines, any accidents, the kind of which we saw coming out of the pandemic, where we had a big problem with Target managing their inventory? Are you expecting anything like that in a different way this time around?
Absolutely. And I don't know if this is specific to Target necessarily, but what we've seen as the China tariffs were at 145%, what we saw was that there was a lot of stockpiling of inventory in China. So there were finished goods that were sitting in ports in China, not boarding ships, because the day you board the ship is the day you get tariffed. So a lot of suppliers were kind of playing the odds and saying, let's just hold this in China and see if we get tariff relief. That tariff relief came this past week. And so we are going to see a surge in inbound inventory as all those finished goods now board ships. They're going to be in the U.S. in the next few weeks. So we are going to see a surge in inventory. So we could see some inventory landmines, as you called them, across the sector, depending on what the ordering behavior has been. But absolutely, I think that drives some promotionality. I think it helps maybe secondary market, like it would help the off-price retailers, but the primary market of brands and retailers would be hurt by this.
Interesting. Deeply thoughtful stuff, Aneesha. Appreciate your time going into a key week for some of the retailers. Aneesha Sherman there of Bernstein, looking ahead to Target and Home Depot next week. So difficult to manage your inventory over the last several months. Remember the port strikes and how much Target found it difficult dealing with that moment. Try dealing with the last couple of months as well. On top of that,
this has been a moment of supply chain rethinking and supply chain shocks. And the real question is, how do companies get ahead of this? How do they plan for this? And how do they remain nimble at a time where it's probably going to be more like this going forward? I do just want to go back to the point, and you asked her the question, how much do you see winners and losers in the divergence there? And the consolidation among smaller players is going to be really notable at a time where the big players, even Target, has a real advantage over them.
Retail earnings next week. Looking forward to that. Looking forward to more economic data later this morning as well. Another read on consumer sentiment in America. In just a moment, we'll catch up with Kathy Bostjancic of Nationwide, and we'll speak to Stephanie Larosiliere of Invesco from New York City. This is Bloomberg. The opening bell is 60 minutes away, and equity futures are near session highs, up by 0.4% on the S&P 500. With your morning movers this morning with Danny Berger. Hey, Danny.
Hey, John. We got some serious pressure for Applied Materials this morning. Gave earnings after the bell yesterday. It is the largest U.S. maker of chip-making equipment, ringing the alarm bell. The current quarter, the guidance was very lackluster, really underscoring how difficult of an environment this is to navigate for chip makers, with restrictions coming on and coming off. The CEO saying that it is a time of uncertainty. Those shares down 4%. To the upside this morning, though, is Estée Lauder. We got 13 F filings, and that seems to really be dominating the market move here. From Michael Burry's Scion Capital, they basically got rid of all of their equity stakes. They put puts on Nvidia. The one thing that they seemed confident on was Estée Lauder. They doubled their position. So this market, even though that's backward looking and from March 31st, the market's still paying attention, sending shares higher by 4% in the pre-market. Wrapping things up with some deal news, we learned that Charter Communications will be merging with Cox. The deal values Cox at around $34.5 billion. This will give us the largest U.S. cable provider at a time where there is increased competition for both wireless providers and streaming service. The hope is that putting these two behemoths together will make it easier to compete, build out infrastructure, and bundle products. So those shares up nearly 4%, John.
Danny, thank you. Thanks for this morning. Thanks for this week. It's been a big week for the U.S. consumer. We had a read several times, once with retail sales, another time with Walmart earnings. You'll get another read going into the weekend, a fresh read at 10 a.m. Eastern Time with the University of Michigan Consumer Sentiment Survey just around the corner. Mike McKee joins us now for more. Good morning, Mike.
Good morning, John. Well, Americans hate inflation, and we've got a little bit more inflation in import prices just out from the BLS import prices up by 0.1%, but take out petroleum and they're up 0.4%. And you look under the hood and non-fuel industrial supplies and materials were up 0.8% after just a 0.1 rise the month before. And capital goods up 0.6%. Guess why that is. And then what we'll see a little bit later is when the people start crunching, we'll get the PCE forecast for the end of the month because we've now got CPI, PPI, and the import price numbers. Housing starts also out up 1.6%. It's a rise, but it's not as much as expected. The forecast was for a 3% rise. Building permits are down 4.7%. Remember, yesterday we saw a huge drop in the National Association of Home Builders Optimism Index, and so they may be cutting back. Those bounce around, but certainly housing not in good shape these days.
Mike, do we expect that sentiment number to bounce around as well? We talked so many times about that spread between the hard data, resilient, the soft data right down here and cratering. After the truce over the weekend, does it make a difference?
Well, that'll be an interesting question to see in the Michigan numbers to see if that registered with people enough that they will feel a little bit better about it. And so you also wonder how low can that indicator go. But we'll see what they say about their inflation expectations as well. Hard to know if it's going to move a lot given how much they've gone up. Remember, 6.7% is the inflation forecast over the next year. So we're not looking at people who are thinking inflation is under control.
Mike McKee, thank you, sir. That's the number I'd throw out too. 6%? Yeah, why not? Make it 10.
Is that what you would say if they called you?
They don't call anymore. Is that all online based now?
Well, that's part of the problem. Some people say when you're online, you're angrier and have more catastrophic thinkier.
Just 20%.
Yeah, just
next 12
months. 150.
It's important, though, that this is how they feel. That's what they believe the actual numbers are. Because when they go to pay for things, they're so expensive. And I remember earlier this week you pointed out gasoline. Will lower gasoline prices begin to shape perceptions of inflation in the other direction? Because we've seen a sizable move in gasoline.
That's one reason why President Trump is focused on it. It is a psychological indicator. It is the billboard of inflation because literally there are billboards telling you the gas prices everywhere. And when you see them going up, oh my goodness, when I fill up my tank, it costs a lot more. And when it goes down, it's the opposite. So here comes this question of going forward. Does that offset some of the actual inflation that you're seeing elsewhere and make them more able to pay for it, meaning that it can be stickier in other places?
Will it help to anchor inflation expectations? We'll see. We get that number at 10 a.m. Eastern time, so look out for that. The Federal Reserve so far this week echoing a similar theme. They're going to sit this one out and wait and see. Kathy Bostjancic of Nationwide Mutual Insurance writing this. We still look for the Fed to wait until September to cut rates. Expect them to go with a larger 50 basis point rate cut followed by another 25 in October. Kathy joins us now for more. Kathy, welcome to the programme. Where does that come from? What's the situation you believe that starts to evolve over the coming months that leaves them in September, reducing interest rates by 50 basis points?
Yeah, good morning, John. So I think by then they're going to have some evidence of the economy slowing, and particularly the labor market. That's really going to be the reason they cut rates and go a little bit larger. They're going to wait longer because of the inflation impact, and they want to see how that plays out. Is it persistent or temporary? And then so because they're going to wait, they're going to have to go a little bit more, is our thinking. Go 50 basis points in September, another 25 in October. Then I think they sit December out and probably all of next year, because it looks like we're going to get a lot of tax cuts and stimulus for next year. But they'll have that kind of brief window of opportunity to come in and lower rates, which by their own admission they're restrictive right now.
I'm pleased you're thinking about December because I can't get past next week. Can we focus on the next couple of weeks as well? Kathy, the data we get between now and the end of the Federal Reserve's next window for its meeting, which is in the middle of June, you had this to say in April. You expect the GDP to stall out. Does the trade truce make a difference? The tension and tug of war between the policy volatility of April, the trade truce coming into May, and what it means for the data in the next couple of months?
Yeah, great question. So there's going to be a lot of shifting in the data. So we're going to continue to get that import surge, as Lisa talked about before. All those ships that were waiting goods, they're going to still come in. That's going to depress GDP growth at the headline number. Consumer spending, I think, we're already starting to see it, the pullback right after the front loading, but inventories should start to rise. They're pretty thin right now. So there's going to be a confluence of kind of offsetting factors. It'd be hard to get a real great read, but I think really focusing on the consumer and labor market to me is the key, because you're going to have the tariff impacts are going to skew the data, but I really want to know, how's the labor market looking? How are employers dealing with this? Just as, again, was discussed earlier, if they're not passing fully on the higher tariff price increases, they're cutting costs. The best way to cut costs is labor, unfortunately, and that's only going to further hinder consumer spending going forward.
So, Kathy, let's build on that. Do you think that what we heard from Walmart this week, that they have to raise prices, they cannot absorb all of the increase from tariffs in their margins, does that make you think that that's actually going to foster greater layoffs in other businesses that aren't as capable and resilient and large as Walmart?
I think it's a great point, because I think it will depend on the size of the firm, right? And the different industries and how much pricing power or profit margin they have now. Are the margins really thin or not? And I think it's also a really interesting point that a lot of retailers and even automakers are waiting, because they don't want to be necessarily the first one out the door. They want to kind of size up the environment. You sort of heard that with Ford at first, and even now kind of gently suggesting prices go up for certain models. But Walmart, that's a hallmark, right? Like when you hear Walmart come out and say they're going to raise prices, that suggests others are going to follow, and we will, I think we will start to see the price impact in the data going forward.
There's the Fed Chair, Jay Powell, that wants to understand just how much people are going to pay those prices, how much they're willing to it. And then there's the other central banker, who is Doug McMillon, as he looks out and sees how much people end up passing that along and actually absorbing that. Do you have a sense, to John's good point about gasoline prices, about whether lower gas prices will make consumers more able to absorb some of those price increases and actually, frankly, be more resilient than many people expect?
Another great point, because and it's just such an unusual time right now to see crude oil prices plummeting, and it's not just because of demand, it's also supply and gasoline prices coming on. And to the point, gasoline prices is a high frequency purchase. We tend to do that every week, fill up the tank, and that can free up, certainly if you're spending less on energy, it could free you up for non-energy purchases and discretionary. That said, I think the consumer is still going to be cautious. I think there also is so much forward pulling of consumption, like all else equal. If you bought a car or a refrigerator or whatever, even non-durable items, you're not going to rush out to stock up on them just because gasoline prices is going down. I think you're still cautious, but it certainly helps on the margin, no doubt.
Kathy, appreciate the update from you. Have a great weekend. Kathy Bostjancic there of Nationwide Mutual Insurance. It's going to take a lot of bad data to convince people things are bad. It's going to take a lot of good data to convince people things are good, because the data is going to be so distorted over the next several months or so, which takes me back to the Andrew Hollenhorst call over at Citi. The idea that the Fed's in a position in July to cut interest rates. They're going to need to see a lot of weak data to get to July and be convinced they need to reduce interest rates.
And it has to be specifically weak data. It has to be weak data when it comes to the labor market, because that is a forward kind of driver in terms of activity. I'm just struck by all these different cycles that are kind of layered on top of each other. We've been dealing with this for a while. There's the tech sector and that cycle. There's the economic cycle. There's the geopolitical cycle. There's the trade cycle. And you kind of have to overlay all of these things and figure out what's where. And that's the reason why when people come on, they feel like, oh, yeah, there's that.
Which is why
there's that.
The market's only doing one thing at a time.
Exactly, because how can it do anything else?
Moved away from trade, it's now focused on taxes. To think about trade again, they're going to have to see some bad data related to the tariff story.
This is what anybody does when they're overwhelmed. They compartmentalize, and that's what the market is doing.
Good therapy, eh? Guess you're doing a better place in financial markets. Right there with you. Joining us now, not for therapy, for market calls, Stephanie Larosiliere. Stephanie, welcome to the programme. It's good to see you. Let's talk about whether you've heard a compelling argument to bring capital back to the United States. A truce with China, the prospect of a tax bill in Washington. Is that enough?
So we've taken to nowcasting is what we're calling it, because of the amount of uncertainty that is just in the market, in the news, in the headlines. It's really hard to make a distinction, much in the future at this point. So when we look at what's taking place with China and the truce there, well, that's a truce. It's a 90-day pause. It's not concrete. For us, what we've seen and heard has allowed us to take down our recession fears just a little bit. We had a 50-50 sort of outlook in terms of recession versus soft landing. Now we're maybe 45% on recession just because it's a good sign. But if we think about China, who has been our biggest adversary from a trade war perspective, they're now on par with the UK. UK, by most accounts, is one of our friends, right? And so having China with the same type of tariffs as the UK feels like something is going to have to change. Doesn't feel like we're near the end of this trade war with China. So we're still paying attention. We're still navigating. It's going to be very difficult because, as you said, political headlines, geopolitical risks. Now we have, the tax bill in Washington. So much uncertainty is built into the market, just making it really difficult to really have a long-term forward-looking projection.
Do you feel like you have a higher recession probability than the market does right now, given some of the rally that we've seen in risk assets and, frankly, the loosening up in financial conditions?
So I would say that, our viewpoint right now is that if we continue to see what we've been seeing, we need more than concepts. We need actual deals. We need more than pauses for us to feel certain about stepping away from the recessionary fears. So, as long as we continue to see sort of the continuation of what we've been seeing, and it's interesting, you guys were just talking about oil, we'll see what kind of deals come out of the Middle East, and whether those are actually concrete deals that can help Americans. And that may actually, change our outlook regarding recession.
As John was saying, our focus seems to be shifting very quickly and collectively from one thing to another because we cannot view all the things at once. And when we try to, you start sounding like me. So there's this question of how much our focus is moving from international to domestic, especially with the tax bill and what's going on in Washington, D.C. How much are you concerned about the ramifications of some of these cuts on municipalities, on local governments that have, frankly, been some of the big drivers of hiring over the past 4 years?
Yeah, so when we look at the municipal market, we look at the credits in the muni market. The credits here have been in good shape for quite some time. We've been looking at upgrades to downgrade ratios that have been very favorable for municipal issuers, for states, for local governments. We're looking at rainy day funds. So, the states and the local governments have been through the exercise of having to deal with fiscal constraints over the years. And what they've done in response to that is increase their rainy day funds, increase their, pool of capital that will help them in the event that something takes place that is unprecedented, that they're not necessarily prepared for. So we feel good about where munis are. We think, munis are going to continue to see some volatility because of what's happening in the trade market. But really, at the end of the day, this is a problem for the muni market, but it's not an actual muni problem.
Lisa's very worried about New Jersey, aren't you?
I am.
I know you are.
I mean, honestly, this is a problem. If you can't pay people, 450 people to come to the office or come to the train or come to the bus, get people over, then, that's going to be a problem for the work from office, which is the big thing. And I mean, this is going to be for all of us.
That's why they're pushing for a big SALT deduction. Get them more relief.
Okay, look. There's a bigger discussion here about whether blue states get disproportionately affected than red states from some of the budgets. And honestly, I think
taxes are just too high in blue states. Let's put it that way.
You could have that discussion. You could say they should just lower the taxes. And then, but then you could also say that some of the economic engine of the nation and contributes to disproportionately to the overall GDP of the United States. So you could make that argument as well. There are lots of arguments out there.
Some of these southern states are doing fantastic. Florida, always this great example of what you can do with the budget, and why can New York not do the same thing? I hear that comparison all the time.
Okay, well, we should do that sometime. But I will just say these are the things that are being discussed. And I'm just saying, though, that states have been a huge driver of employment, and they've been a huge driver of the economy. And if they have to start pulling back, including in places like Florida, that might have a ramification for the economy and certainly bonds.
We've run out of time this time. Stephanie, appreciate your time. Stephanie Larosiliere of Invesco. Stephanie, thank you very much. We can do that next week if you want. We'll make time for it.
We don't have to.
We don't do Moonies enough.
No, we don't. Well, I actually think it's really important. I actually think that they might get more interesting, especially as these cuts come into focus.
Let's have that conversation next week. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara. Hey, Yahara.
Hi, John. President Trump saying he will set a tariff rate for a number of U.S. trading partners over the next 2 to 3 weeks. He says Treasury Secretary Bassett and Commerce Secretary Lutnick will begin sending letters to about 150 nations that the administration doesn't have time to meet with, but he says want to make a deal. Meanwhile, a roller coaster week for Coinbase. The company was added to the S&P 500 earlier this week. Now it's facing a hacking and an SEC probe. The crypto exchange said hackers bribed its foreign employees to steal customer data and demanded a $20 million ransom, which it refused to pay. Coinbase is also cooperating with an SEC probe into whether it misstated user numbers. And in sports, the Denver Nuggets and Oklahoma City Thunder are heading to Game 7 after Denver staved off elimination. The winner will face the Minnesota Timberwolves in the Western Conference Finals. And the Knicks will look to close out their series against the Boston Celtics in Game 6 tonight at Madison Square Garden. If they win, they'll make their first conference finals in 25 years, and New York will go crazy. That's your Bloomberg Brief. John?
8 p.m. Yahara, thanks for that. Have a wonderful weekend. 8 p.m. And I think the ticket prices would make me cry, so I'm not even going to look.
I think that the lowest one is some $600, I think, but I think it might be more than that.
I reckon you'd be lucky at this point to get in for 600.
Oh, you wouldn't actually get it. Somebody else has it, and it's actually.
Oh, it's gone already?
I'm sure.
So there's nothing available. All right.
I haven't actually.
What's like the get-in price? It must be thousands.
Yeah, well, it's not a club I'm part of.
What do we call them? TK seats?
Yeah, exactly.
Yeah, they're like, yeah. We'll have a look later. All right, up next, we'll set you up for the week ahead. We'll touch base with Tyler Kendall. Big weekend coming up in Washington, D.C. From New York, this is Bloomberg. Nosebleeds, Celtics, Knicks, Madison Square Garden, $666.90.
So there you go. It's cheap.
Yeah.
You can buy some.
Ridiculous.
Yeah. Look, this is the issue, right?
If you want a view like where you can see thousands.
Yeah, well, I guess that people have seasons tickets, and it's for people who can afford that. And I guess that, you're not going to be there, are you?
I'm not one of those guys.
Me neither.
If you've got a ticket and you want me to come with you tonight, no, we're not allowed to do that. I didn't just do that. Equity futures on it, I can't go. Equity futures on the S&P, up by 0.25% on the S&P 500.
You can donate them to a trust that
that
has his name on it. No, it doesn't work that way, but we can
say
create
no
a new
all
thing.
the time.
Yeah, well, 8 o'clock.
On the Nasdaq, up by 0.25%. So we count you down to the opening bell. Here's your trading time for the week ahead at 10 a.m. Eastern Time. UMich sentiment is coming up before we get into the weekend. This weekend, lawmakers set to continue debating President Trump's tax bill. Tuesday, Home Depot earnings. Wednesday, earnings from Target. Thursday, PMI data and another round of jobless claims. Before you can think about next week, we need to talk about the negotiations taking place this weekend. Tyler Kendall joins us now from Capitol Hill. Tyler, let's talk about how far these two sides are apart going into a key weekend of talks.
Yeah, hey, John. Well, far enough that they do need to work over the weekend to try to come up with some sort of compromise to advance this legislation so that they can pass it by House Speaker Mike Johnson's goal of Memorial Day out of this chamber of Congress. Now, it was interesting to hear New York Republican Congressman Mike Lawler say earlier on this program they're still negotiating beyond just what that number will be to lift the SALT cap to. They're also talking here about the marriage penalty, about income limits, about what the phase out or expiration date will ultimately look like going forward. Will they just snap the SALT cap back to $10,000 over time? And it was particularly interesting to hear him confirm that he does have plans to reach out to President Trump to talk to him about this deal this weekend when he does arrive back to the White House after his Middle East tour. And that really shows us that these moderate Republicans from these high tax states are going to use their leverage where they can. Now, of course, the other part of this are these other Republicans that are going to try to use their leverage, and that's those fiscal hawks who are trying to look for some more savings in this package, or at least some of those savings to be pulled up to happen sooner instead of in a few years from now, as some of them are currently written in the bill. And actually, in just a few minutes' time, 9 a.m. Eastern, a budget committee hearing is set up to kick off. We're going to be watching that closely because these fiscal hawks are threatening to tank that committee markup because they are demanding to see some more cost savings.
Another weekend of key negotiations. Tyler, looking forward to your reporting. Tyler Kendall down in Washington, D.C., going into these talks over the weekend.
What does a fiscal hawk mean right now?
No idea.
I mean, how much do people want to get the budget down? How far are they willing to go? Or how willing are they to go to Medicaid, which is sort of the key cutting ground? These are some of the key questions that I just don't have any grounding in.
I think most Republicans are willing to extend TCJA.
Yes.
because they realise they have to, because they realise if they don't, this economy could get into a little bit of trouble. It's the additional stuff, it's the stuff on top of that. And much of that stuff, pretty much all of it, was promised on the campaign trail.
Yeah, which is the reason why it's very interesting that President Trump has not been around. And now that things are getting tricky, he's going to be having a working weekend, as Annmarie was saying. He's going to come back to the Hill and he's going to say, okay, guys, let's get it together. And that's the reason why, to Tyler's point, it is important to see the fact that Mike Lawler is having a conversation or is going to reach out to President Trump, given that SALT cap and trying to potentially raise it, and frankly, President Trump's affiliation with the Northeast.
Waiting for that first social media post on who he backs and who he's pushing.
What do you think he's going to say? I like salt.
I've got no idea, but I'm with you. I think that New York has a place in his heart. I think that he made a big push on a campaign trail to make New York a feature, and some of the problems that some of these high-tax states were having became a feature of the campaign in a way that was unanticipated several years ago. And I think he's going to be interested in the outcome of these negotiations for obvious reasons.
So let's make a bet. At the end of next week, what do you think we're going to be talking about? Is it going to be the earnings from the retailers? Is it going to be tariffs? Is it going to be the tax bill? What do you think is bond vigilantes? Do you think it's disinflation?
I asked you this question last week, and then I had my answer, and my answer was the drafts of the President of the United States on his social media account. And that's still my answer.
Oh, come on. That's such a cop-out.
Fate of the market is in the hands of the President of the United States.
By the way, it's not approved. We can't.
I saw that from management.
Yeah,
no stock trading, no sports tickets.
No sports tickets, no fun.
All right, that's done.
Go home and to work.
From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another Italian Open update for Bloomberg TV and radio from Tennis Channel. Coco Gauff reached her first final in Rome after coming through a 3.5-hour marathon semi-final against 8-seed Zheng Wen. The American fought back from 5-3 down in the deciding set before closing out the hard-fought victory. Italy's Jasmine Paolini awaits in Sunday's championship match.